Start recording. Okay, we're gonna let everybody come in as we start. I always like how the Zoom, it always has that slow go of participants coming in, like they're waiting or something. But anyway, welcome to I can't believe it's the fifth annual that 401k National Virtual Conference. This is the fifth time we're doing it. Uh, and I'm wearing my Ron Duguay Rangers jersey in honor of the first and only time I ever did a national event. So the virtual event comes from the national event that we had at Disney World. And word to the wise, don't try to plan any conference the week of a global pandemic, but that's what we did back in 2020. For the five people that it was more than five people, but it felt like five people. But word to the wise, never have an event near a global pandemic. Things really just don't work out. We had the event. Mike Webb was there, I remember, and James, weren't you that you were there? Weren't you?
Yes, yeah,
Yes, you were there. Bill, weren't you there? I don't remember Bill being there. No.
I
Bill,
was
yeah,
not. I was not in attendance.
yeah. That was the. I anytime I see Goose Gossage, I make the joke about Goose that we shut down Disney World because we had the conference on Wednesday. It ended and Sunday the park closed. But anyway, welcome to the fifth annual National Virtual Conference. And I wanted our first, before that, go to that4kSite.com. We have live events coming up in Kansas City in May. We have a live event in Anaheim in June, and eventually we will have the sign up page for Milwaukee in September. I got to knock out Milwaukee and Detroit for my goal to get to the 30 major league ballparks. So we'll do that in September. But these are fun virtual, but they're also fun live as well. We'll get more information on a guest. Larry, my buddy Larry's coming up with an interesting idea for a guest. We'll see if he comes through with that for Kansas City. But go to that4ksite.com for further information. And of course, we start things off with that 401k virtual bunch. It's me, Mike Webb, Bill Shores from Invesco, James Holland from Millennium Retirement Advisors, and we talk about obviously the topics of the day. And for a format, we'll take questions for people who have it in the audience. But first things first, we're 10 days in, I guess, to a Trump 2 administration. The first ever national virtual conference, we had a scheduled guest of Jamie Raskin, and he couldn't participate in it because there was this idea for to impeach Trump a second time, and then here 4 years later, he's president again. And what do you guys think about what will happen with a Trump 2 administration retirement plan wise? And I'll bring up some topics that I think will come up. What do you guys think?
Go ahead, Mike. You look like you're about to jump in. So
you know me, always chomping at the bit. Well, I think the bet I have with several people that I will retire before there's a final fiduciary rule. It looks like I'm going to make some bank. I think I'm going to make some bank on that.
I think, yeah, you cash that check. Cash that check right now, Mike. 100%. Yes.
Yeah, I think I've already gotten some offers for some negotiations, shall we say, on cashing in now. And in all seriousness, we've had the never-ending saga of the final effective implemented fiduciary rule that never is, because every time we change administrations, we get another iteration of this rule, and I don't even care anymore. If I agree with everything in it, I just want to rule. I want to rule before I do run. I mean, that's aside. I want to rule before I retire. Any rule will do, beside from the one we have to revert back to, which is the one that's 50 years old. It's just ridiculous to me that we're following stuff from when I was 6 years old, or not even 6 years old.
I mean, it's funny. Like I was working for insurance on site for an insurance company to help them out with the transition rule, and that was 2016. And everybody convinced Hillary was going to win. And politics is a funny game. And I remember as soon as Trump won, That was the end of my tenure there, helping them transition to the new rule, because that rule never made it.
Yes,
In addition to the fiduciary rule, and I agree with Mike, that's going to be killed. I know the DOL appealed it in court, but I think they're going to drop their appeal. They know they know where the road is heading. You have ESG, that's going to be a non-starter as well, in terms of allowing that rule is probably DOA as well. But the interesting thing is the reconciliation bill and the budget that has to come up, and Congress has to find, pay fors for extending the tax cuts to get all the, executive orders and promises of the new administration. They have to reconcile that and come up with ways to pay for this. And one of the largest areas to do that is the 401ks. So I'm hopeful that they leave the 401k system alone. In the first Trump administration, if you remember Donald Trump and his tweets, and now X's, I guess, he had a very famous one that says, we are going to leave your 401ks alone, because there was a big push for Rothification. They backed away from that. So, whether we see more of a push towards, Roth as a funding mechanism, which, it's just the way the government calculates spends, really doesn't make any sense, because they look at 401ks as an expense to the revenue of the government. And it's not, it's a deferral. The money comes out, but they only look at a 10-year window. So they're looking at it, once that money's contributed, it's gone, but it will come back more than 10 years from now.
Oh,
So
we're supposed to get the Rothification of catch-up for HCE
Catch-ups, right.
2026, which I hope gets pushed away, but that's a whole nother story.
Yeah. Well, it was
So-
already pushed once.
but
Yeah, it was
yeah,
already pushed
but
once,
didn't I see some folks already trying to figure it out in terms of I thought I had seen something recently about people who were trying to look at it from make it work from an administrative perspective. I mean,
Well,
from a
because
plan perspective, not an admin perspective.
Because the IRS put in the regs to
Yeah.
talk about it as to how you're going to do it. So one of the interesting parts of it is, if you had an election for a pre-tax deferral, you don't require the participants to come in to do a Roth election for the catch-up.
Yeah.
And I don't like it. Probably, selfishly, my wife is an HC at her firm, and so I like the idea of Roth, but then I don't. I like to have choice. But the problem that I see with it is it's going to negatively impact plans. There are still plans out there that don't have Roth. So if they don't have Roth, they have to offer Roth if they're going to offer the Roth catch-ups. And if they don't want to offer Roth, they don't have to. So people will be negatively impacted.
yeah, they won't be able to offer catch-ups if they don't have a Roth.
Yeah,
So,
correct.
Yeah, the other thing that's going to happen with the new administration is you'll have a much more favorable regulatory environment, in terms of the SEC and oversight. I expect that to be favorable for private markets to make more headway into the defined contribution space. The private equity, private credit, especially private real estate, you'll see more of that enter. You saw KKR hire a head of defined contribution strategy last week. Apollo is very much involved in the defined contribution space. You'll see partnerships forming with the asset managers, and you'll probably start to see more target date funds with a sleeve of 5 to 10% in private markets, as well as managed accounts. So more favorable regulatory there, new ideas, new investment strategies that have not been part of the 401k landscape will probably get some clear runway to try to make headway here.
Yeah, which is a double-edged sword
Yes, absolutely.
In terms of, there are folks who can manage it. The participants in retirement plans are not one of them. So I think, Bill, to your point, if again, not to pick a side, but if they can keep it in a target date, the idea of Joe Smith logging in and choosing 10% PE is like the last thing that we need.
I completely, James. I don't think you'll see private markets as a standalone core menu option, nor should it be. I mean, the last thing participants want is another illiquid, non-transparent, expensive vehicle. However, it's not about he or she who pays the least, it's he or she
No.
who retires with the most.
Yes.
And given the benefits of private markets historically, if those can be carried over to the defined contribution space, because there will need to be some added liquidity buffers, and it's part of a portfolio in measured doses through a target date sleeve, through a managed account. Yes, I think there can be some benefits. There will be some benefits. It's just a matter of, and we're already seeing it in the institutional space, but you have the fear of litigation. Plan sponsors on the high end of the market are afraid to innovate because they're out on a limb by themselves, and that's a target for the litigators out there. So, but I do expect to see more uptake in that, given the momentum of the industry behind it and the favorable outcomes that it can produce.
Could the
What
crypto
about,
sleeve be far behind?
Well, crypto to me,
that was my question. I mean,
Yeah.
I believe that we are going to have it.
Yeah.
I just believe that.
Well, you have an administration that's very favorable to it. So again, clear runways and more favorable. But to me, when you look at crypto under ERISA, you have to have a prudent long-term investment, right? My opinion, only my opinion. I don't know that crypto is there yet. The SEC just approved ETFs and, last year or in 23. So I agree with you, it will be there, but I don't think it meets that threshold of a prudent long-term investment just yet. At some point it will. So we'll see.
Do sleeves already invest in target date sleeves already invest in crypto companies at all? Like, because you could invest in a company, not directly in crypto.
I don't know. Good question, Mikey. I don't know. Yeah, that'd be something worth researching.
Like Coinbase, I'm thinking.
I know that iShares has an ETF that's like, dealing with Bitcoin mining companies, and there is sector funds. I don't know about, just general TDF.
If anyone's holding the grayscale and
there might be small cap funds that are invested in some of these.
I don't know.
Yeah.
Don't know.
But my feeling,
are we taking questions from the audience too, or no?
We will be.
Okay, gotcha.
Once they have questions.
Yeah.
Yeah, we do have the question option. Okay, but or put it in the chat or whatnot. As far as my thing about crypto, I think timing is everything. When Fidelity and For Us All pushed it out, that they planned it when it was 60-something thousand, and they came to the market when it was 20,000. And the problem with crypto at that time was you could only use it with a digital wallet. And I have a Coinbase wallet, and you know how many times people have tried to scam me out of my Coinbase money? I had somebody calling me up claiming they were from Coinbase and that my account was being hacked and I should put it in cold storage. And I said, yeah, and I knew it was a scam. I'm like, do what you got to do. Leave me out of it. And that was the end of the scam. But when you have an ETF, the money's at Fidelity or whoever you're using custodian, it's a lot different. Obviously, you're going to need some guidance, because to me, you got Bitcoin and Ethereum and then like everything else. People who are long on Bitcoin say it's Bitcoin or it's shitcoin or whatever. And it was recently funny. Trump had a meme coin that was going up and down, with the administration. People lost a lot of money. There was the Haktua girl who had her own meme coin. And if you got a website, I thought about for about 3 seconds to do a 401k meme coin. They want my picture to be up on 401k advisor as Ari Rosenbaum being investigated for a pump and dump. And no 401k plan would ever have it. But for about 3 seconds, I'm like, oh yeah, imagine if someone's going to come out with a 401k meme coin, and it's going to stir it up. Oh, and people are going to think that you can put it in your 401k plan, but whatever. But we'll see what's going to go on with that. But I mean, Trump, the candidate, who was getting so much money from the crypto world, may be a little bit different from people having as president having an EBSA or a DOL from having that, from allowing it. But I think in terms of the ESG rule, I jokingly said I wouldn't be surprised if it's done the first week. But we don't have a head of DOL. We don't have somebody from EBSA. It took forever for Lisa Gomez to get her job back on the Biden administration. And we'll see what happens, but that bull's as good as gone.
Yeah.
And I drive a Prius. I like to not pay a lot for oil. I like to eat a lot of hummus and all that stuff, but in terms of an ESG rule, I was never in favor of it. To me, in my opinion, it's all about maximizing return for participants. And until you show me an ESG fund that truly maximizes return versus an S&P 500, to me, it's no different than putting in a risky sector fund, in my opinion.
Well,
But a little pushback, Ari, in terms of just along the lines of it's an option. Again, I'm not. So if you have an all ESG lineup, yes, you're going to be in trouble because just like Bill said with the crypto or the PE, you can't justify that from a fiduciary perspective, saying that you're solely and exclusively putting the interest. But if you have a group that believes in a certain philosophy and you give them all these other choices, but there is that ESG sleeve to pick from, then the person had the opportunity. It's no different than an active passive argument. You give them the choices, you meet the criteria from an ERISA perspective. Again, you have to vet the fund like you vet any other fund. But if someone believes in a certain philosophy, there's no reason they shouldn't have an opportunity to choose. They just can't be the only one.
Yeah, and I'm curious to get Mike's thoughts on this as well, but just, Mike and I had discussed this at a conference. We were on a panel last week, and let's define ESG first. It's not, nothing is excluded from being in an ESG label fund. You could still buy casinos, tobacco companies, gun manufacturers. You're looking for those types of companies that are the best at in being environmentally conscious, socially positive, and good governance practices. The other type of fund that we're talking about there is socially responsible funds. Those will avoid.
Yeah.
Every asset manager, I don't care who you are, whether you're Invesco, my firm, BlackRock, Franklin Templeton, whoever, every portfolio manager incorporates ESG into their stock selection process. You are not going to buy a company that treats its shareholders like garbage. You're not going to buy a company that is not a positive part of its community or is polluting rivers and has horrible environmental standards. So that's what ESG is. It's been around for over 30 years. It's not new. It's become a political football over the past few years, and I'm not even sure why, but it has. The Obama administration went too far and said you can select ESG above return considerations. The Trump administration, the first Trump administration, went too far the other way. They said you can't even talk about ESG, can't even mention it. Then the Biden administration said, okay, we have this political ping pong ball going on. Let's try to get a neutral stance. You can consider ESG, but in no way can it be placed above pecuniary outcomes. Right. So that seemed to be a reasonable middle ground. Yes, you can consider it to break ties, but performance always comes first. Yeah. So I don't think that's even going to survive now. So every manager does it. It's just a matter of how much they broadcast it and how much they advertise it. ESG is not a sector. It's a philosophy over how you want to select stocks within your portfolio. Some will label it ESG because that's the primary factor that they consider. But we'll see where it lands. But it's not going to be something that fiduciaries are going to be able to consider as part of a rule with the new administration. And then
have you really
back where we are.
You're the national DCIO for Invesco. Have you really seen an uptick for plan sponsors and advisors interested in these funds?
It depends on the geography. So if you go on the West Coast, absolutely. You go up to the New England, absolutely. You look at nonprofits,
yeah. Obviously, because they have a philosophical tilt to what they do, of course. Yeah.
So nonprofits, Vermont, Pacific Northwest,
the exact places you'd expect it to be.
Yes. Yeah, I'm a 316 of a school, and they're a private school, and they wanted to add an option, but most.
So Mike, anything you got or?
Anybody want to invest in badly governed companies? I still have my pets.com puppet around here somewhere, I think. Anybody want to invest in pets.com?
There you go.
You know, I mean, like this is what we're talking about. Like, it's not a political thing to not invest in badly governed companies.
I don't think
You
there's a
want to be
worse.
an Enron?
Yeah, Enron, AOL, Time Warner to me is at the
Yeah.
top of my list. I owned AOL, Time Warner for about a minute in 1999. So yeah,
There you go, Mike. So we'll make an ETF with banned meme coins and banned companies. And it'll be the
Well, we do have
inverse.
meme funds. We do have meme funds now. Anybody want to put their hard-earned cash in those? Yeah, we got
Exactly.
there is
GameStop and
what-
AMC.
isn't there like I forgot the name of it. There was somebody created an ETF where it was all going to be like the GameStop stocks and all the kind of
Oh, really? I didn't hear about that.
there is. And
That
I
would have
forgot
been
the
funny.
name of- I forgot the name of the ticker. It was kind of fun. I don't think it was Rave or it was something weird like that. But I don't think it really caught on.
Although I'll give GameStop credit, that GameStop store by me is still open. That brick and mortar store is somehow still open. Nobody goes in there, but somehow they're still plugging away.
It's like what is it, the mattress firm, right? Or the sleep.
Oh my God! I mean, I live in a
It's
town,
familiar, but no one ever buys them from them.
I mean, I live in a town of 30,000 people. I live in a village of 30,000. We had 3 mattress firms, and I'm like, how often people changing mattresses? And it always reminds me, I got to change my mattress. I think it's been,
Well,
I
they're
think I
amazing
changed
because
my
they bought
mattress
all the competition. Like they bought Sleepy's and the other places.
Well, everybody,
And instead of closing the stores, they just made more mattresses. Like now your town's gonna have 3 mattress firms. It's like the private version of the post office.
Yeah, but at least in Houston, it's interesting because you have Mattress Mac, and he's the guy who does all the betting on the Astros. I mean, and then if he wins, he gives savings to his. But that's a racket. But then again, in my town, we got like 50 million nail salons, and that drives people nuts.
Next topic.
What do we think about? So, I mean, tax legislation is certainly going to be on the books. We have, I don't even know when that legislation that's the kind of like that secure 1.0, when does that sunset? Usually, it shows you how little I'm like, I follow. To me, it's like, I don't follow the rules until it's like the rule.
Well,
People, if you ever read my writing, I never talk about proposed regulations or this. I don't have time for that. Tell me what the rules are. It's usually a 10-year sunset.
yeah.
If I
The
recall.
Tax Act, the Tax Act sunsets, I think, in 2027. I think.
Yeah, that's what I thought. Yeah. So
But secure doesn't sunset that I'm aware of. Not every bill has a sunset
I think
provision.
they pushed it out, and it was over a series of years too. Like 25, you had to do this. 26, you had to do that. So
Right, but there's no sunset clause.
No, we don't revert on the secure stuff. We don't revert to what was before, but on the Tax Act stuff, which was the 2017, we do revert. I think if it doesn't cast by 2027, we revert to all the old rules.
yeah, I remember EGTRA, because EGTRA to me was like the biggest game changer, and I remember when that was a 2001 rule that was a sunset in 2011. So it was like you'd have catch up, and then if you didn't make it permanent, it would just go away, and then you'd go and it would go back to the old limits, which was like
Yeah, that was part of the Economic Growth Tax Reconciliation and Recovery Act. So that's part of a tax bill. And they generally tend to have that 10-year.
I tell you, if this was around the horn, I'd give you 5 points for remembering the acronym.
About to say, it's more than 5 points.
I mean, I'm lucky that I remember the Taxpayer Relief Act of '97 when I was going for my LLM. I mean, but wow, I don't see. Wow. Good for you. I mean, wow, that's impressive. I don't remember what I ate for breakfast yesterday.
Yeah.
That just and it's the older you get, I like forget names, like of people. Like I can say, their face, but I'm like, oh yeah, so and so, and it's like on the tip of your tongue, and you just like completely forget, their name or whatever. But let's go to another topic, the forfeiture cases. Those were, to me,
it's
yeah.
And so it's the whole again, full disclosure for everyone here listening. Part of our practice is expert consulting, so we're involved in about 28 of the cases out there, none of the forfeiture, and everyone's just trying to find the next novel idea to get it over the hump. And I mean, why would you pick the highest hurdle? I mean, it makes no sense. I mean, is there a document that doesn't say you can basically do anything but spend it on a trip to a casino with the use of it? So, I mean, what is it that and they're just trying to find some way to get past the 12b-6 and there's just easier ways. I think you're barking up a tree that you just don't need to, and you're going to end up getting bad case law out there, which is good for plan sponsors and defense counsel, because then they'll have cases to revert to. But
this will be like the BlackRock cases to me.
The BlackRock TDF cases. Again, everyone's trying to find some nuance, and I just don't see where you're going to get a lot of leverage. But go ahead. Yeah.
One of my favorite movies, I always like mobster movies, and I always talk about it, Donnie Brasco. This was a movie, they were part of the Bonanno family, crime family, and, they have to meet every week to meet the take. You always see that in Sopranos. You got to meet the weekly take to kick up to the higher people. And there was a scene where they're taking out parking meters, and they're hitting the parking meters with hammers to get coins. And that's, I think, in the days when I was a kid, it was like a dime, and then it went up to a quarter. And to me, this is no different than some of these, and I'm not talking about our Jerry Schlichter. I'm talking about other firms, and Jerry Schlichter, I think, probably got burned on one of the TDF cases. But when you're class action cases, it's like you're recruiting people for cases, and you're putting out money with the hopes that your plaintiffs are going to get a settlement, and then you'll be able to get 33 to 40% plus costs, and it's a huge outlay. And I mean, these forfeiture cases, and I'm like, when I first started, I'm like, wow, that's a novel theory, but how is that going to go anywhere? Because, ERISA's been law since 1976.
Yeah. Well, I mean, what is it? There's been like 6 and 4 already been dismissed, right? And
right. But think about this. I mean, I give it. I love creative. My son's right now in Nassau Community College. He's taking creative writing. I love creativity. I really respect. Everybody knows that I love creative marketing. I think the Retireholics. I've said it. I wish I came up with that idea. I think that was one of the great ideas in the retirement plan space. This case is a great idea, except for the fact that since 1976, the Department of Labor has never opined that the use of forfeitures for an employer to save on their contributions is a prohibited transaction. And
so, yeah, Mike, anything on?
Yeah, I mean, I agree. I mean, I'm in agreement with Ari. I mean, it just is just, you have. I always look for silver linings in things, and I think the silver lining of the fee lawsuits was that fees did come down a little more, and the silver lining of the university lawsuits was a lot of places consolidated the number of vendors they had, because a lot of places had more than one record keeper, which doesn't make a lot of sense to me. So there were good things that came out of those. What good thing is going to come out of these forfeiture lawsuits if they gain any traction? All the employer is going to do is say, well, I have a budget for my employer contributions, and guess what? Since I can't use forfeitures to reduce future employer contributions now, I'm just going to cut your retirement plan contribution. Is that going to be what everybody wants? Is that going to be make us all happy? No.
Yeah, so I agree, Mike. And the lawsuits now, and again, just my opinion, not my firm's, they're doing more harm than good. It's not like they're ambulance chasers, because at least with an ambulance chaser, there's been an accident and somebody's been hurt. In this case, that hasn't happened. So the plaintiffs' bar has clearly identified ERISA as a growth sector. The forfeiture suits are very interesting because, Ari, to your point, the IRS and the DOL have never opined on it. It's been accepted practice for 30 years plus. But from a fiduciary point of view, they do have some merit in that if you have a choice as a fiduciary on what to do with these dollars, your role as a fiduciary is to put the participant first. So is the treatment of forfeitures a settler function or a fiduciary function? And I think that's where these cases are landing. And the way around it isn't to stop the match, it's to make sure your document isn't squishy. How's that for a technical term? Forfeitures will be used to offset employer contributions. full stop.
Yeah.
Now a lot of documents say forfeitures may be used for any of the following reasons.
things.
You know, that if it says may, if it, you know, now the employer has a choice of putting themselves first or the participant first. And I think that's what these law firms are looking for, is the document or the audit of the 5,500. And I found one. So when in my session on the anatomy of a 5,500, we'll go through that and look at the forfeiture language in the audit. And that's how these law firms find these plans. So if you're concerned about this, make sure your document is not ambiguous on the treatment of forfeitures. Forfeitures will be used to offset employer match. Forfeitures will be used to rebate fees, you know, to offset plan fees. So no may, no the following, and you should be okay. But you know, again,
Well, to
there's
me,
no guarantee.
I've had the discussion. Like I have an advisor that some of you guys know, and constantly with the questions about the plan sponsors, but they're never going to get sued. And I always say, you know what? As long as you're paying for using it to reduce plan expenses,
Yeah.
you're going to be here and clear. Just don't be, you know. I think, you know, to be a cheapskate and use forfeitures to offset contributions, when again, when you have the ability to use it to pay plan expenses, use it to pay plan expenses.
Yeah, and you're right. Our, you know, plans down market, you know, plans under like 500 million in assets, they're not going to be on the A list of targets. However, for the advisors, you know, listening in, what will get you sued on the large end of the market will cause you to lose a plan on the mid and small end of the market. It will also create opportunity for the DOL and IRS field audits. Yes, forfeitures are not part of that scope, but some of the other fiduciary practices that get plans sued on the large end of the market, you know, can come back to bite you with an IRS or DOL field audit. And in a competitive situation, it can cause you to lose a plan to a competing advisor. So just because plans that you may be working on aren't large enough to be sued, doesn't mean you should be ignoring all of the issues that come up in the litigation.
100%. Yeah, no, and to further Bill's point, that as you go down market, there is no in-house counsel, there is no, you know, and the committee is the last person to volunteer, and so you know now so the fiduciaries, who probably half of them don't even know they are making the decisions that are causing trouble. So yeah, and that's where they need the advisor to step in. I mean, doesn't the IRS tell them they have to use it within that 12-month period anyway? I mean, wasn't that always the rule?
Because
you always see the balances. So you know, I just don't see how it's gonna.
Yeah, the small plans, I used to call it, they used to build like war chests, where for 2-3 years they didn't allocate the contributions or do anything with it. And I said, you know what? There are participants who terminated who should have gotten a share of it or some benefit out of it. You can't do this. And then the IRS came back, and it's pretty much, you got to do it every year per the plan document.
And like Bill said, just write it in. This is what we're doing. That's all. And then as long as you follow it, then you're good. Yeah.
I used to be a most popular person back in the day, because my first thing that I would do with any prospect is I would say, what's in your, do you have a forfeiture account? And they'd be like, oh, I have a forfeiture account. So, well, your plan document has a vesting schedule, so you do have a forfeiture account. And they would find like, tens of thousands, hundreds of thousands of dollars in there. Like, I was like, what does your document say you can use this for? It's like, good stuff. You know, I would be the most popular guy on the planet for pointing that out to them, because their existing advisor never pointed that out to them.
Yeah.
Anybody here, has anybody here ever been in a plan where they gave you back the money, the forfeited money, after a certain, you know, when someone left? I was.
Oh, okay.
Way back in the day, I was.
Yeah, but you've been working at some firms forever. I used to.
Yeah, in the 90s, this happened to me. And it would say, it was this, to me, it was just the dumbest thing about it. Congratulations, you now have $8 in your account because Mary Jane left us 5 years ago and didn't come back. And
speaking of Mary Jane and all this stuff, what about this comes to the Department of Labor's lost and the lost account program that they're going to have now, because the lost and found database that they're relying on the industry to come up with the information on. Did you ever get those letters from the Social Security Administration where
Yes.
some participant who left in the year of the flood all of a sudden thinks they have like $19,000 coming to them?
Yeah, they give them that letter. They send it to the person. They're like, "I had my money here 30 years ago. The Social Security Administration says I did, and that means I have it now." What?
I've never come across somebody who ever had that.
No. Yeah.
Now, if the DOL and the IRS could get together, and the DOL could have a really good lost and found database, and say, you know what, we don't need the IRS, we don't need the SSA anymore. That would be great.
I think that is going to be the end of the SSA, because the SSA,
Oh.
it reminds me, remember back in the day when my friends at Brightscope, who are no longer my friends because they got sold out to private equity, when Brightscope, James, of course, remembers when Brightscope
Yes.
came out. And remember, the biggest knock against Brightscope was it was giving old, stale information. And then when we did the 5500s, when it all had to be electronically filed, then the new information came out and it was up to date. And I think that, the Department of Labor's database, relying on the the 5500s and all this kind of stuff, will eventually have good information to get participants, their money. But it always reminds me of those controllers lost in fund, the New York State, the state controller.
Yes, we found $19 and yeah, go claim it by
once I found it,
but and when it all comes to fruition, obviously the larger record keepers are going to be ready to go because they have the vast majority of the data anyway. So I mean, there's no way the government's doing it by themselves. So at some point, whenever this conglomerate gets together, it's gonna, clearly the folks who are doing the most plans are gonna have the easiest way to approach finding those people, which is just another way of, collecting more assets. So,
but yeah, if we can mount a campaign to get rid of, use the database to get rid of that filing, that would be so good. That's like the worst. Especially for really large plans, it's like the worst filing ever. That Form 8955 SSA.
8955, yes.
What used to be, I think, just Form SSA, and then they added the 8955 part.
Yes.
Just horrendous.
Yeah, it's certainly. But where else do you think of ideas of like the next wave of litigation? I mean, is there anything that you see pressing in the retirement plan space that is begging for a lawsuit?
Well, I mean, yeah, again, Mike.
Go ahead, James. Now.
Yeah, to Bill's point again, it's everyone's gonna try and find an angle in terms of looking at it. I think advisors best beware. I think everyone else is getting squeezed. A lot of compensation has gone unchecked for a long time, and it won't be big dollars, but it can be McDonaldized. There are certainly advisory firms that set certain fees, and we've done some research on some of them, and it's gonna be hard pressed to justify making $400,000, $500,000, $600,000, $800,000 a year on a retirement plan because you can't bring that much value. I mean, for the time that you spend, it's going to be hard. So I think it's going to be very niche in terms of, obviously, because there's not that many, but I think that'll become a target for someone, only because I think that's a math thing that can be figured out relatively easily. So don't hold me to it, but that's one area I think that certainly would is going to raise some eyebrows.
Yeah, I think the good news is, in terms of the next wave of litigation under ERISA, you'll probably see it start shifting to healthcare.
100%. I thought we were talking about retirement.
No, but that's, in retirement. Yeah, I agree with you, James. I don't see any new novel ideas out there in the 401k space. You already have fund performance. You already have you've had lawsuits because you were in passive funds and you didn't factor in performance. You've had lawsuits because you were in active funds and didn't factor in fees. So no matter what you do, there's no place to hide. So from fees, expenses, fund performance, forfeitures, I don't know if there's a new, but I never would have guessed forfeitures was gonna,
In a million years, Bill, I'm with you.
So,
Never would have thought that would
you
have
know,
come.
I think maybe the pressure's released a little bit with the plaintiffs bar migrating to healthcare. Because they have 408(b)(2) requirements now because of the Consolidated Appropriations Act. And maybe that'll take some of the pressure off the 401(k) space, but I don't know
It
what the
will.
next.
Yeah, so that
idea is.
I'm gonna hit on that a little bit at 132 as well,
Okay,
Bill. But
gotcha.
yeah, and that is gonna make the 401(k) stuff look like lunch money. I mean,
Yeah.
there are hundreds of millions of dollars
Yeah.
swishing around in that space. So yeah, that is definitely something plan
Yeah,
sponsors are
it's
gonna
it's like
need to.
Willie Sutton. Why did you rob the
Yeah,
banks? Well,
that's where the
where the
money
money
is.
is.
That's
Yeah.
where the money is,
So
exactly.
that's where the money is in the healthcare side. So anyway, sorry to
Yes.
go off on the
Go ahead,
healthcare.
no, I agreed
To
100%.
me, the last area, and I'll get in trouble for saying this, but I think that one of the last rackets left is deconversion fees. That a TPA, I get fired tomorrow by a client. I don't charge, or, I just got my oil change. And if you read my articles, I've used the same mechanic for the last 28 years. I haven't, if I fire Ralph tomorrow after he just put the synthetic in my 2012 Prius V, he doesn't charge me for changing and sending the information to the next mechanic. But in the TPA world, there's still that idea that if we're going to move to another TPA, we're going to charge you a certain amount of money. And for most of the agreements I've seen, it's never disclosed exactly how much they will charge. And it is always based on, James remembers I had a plan, that was a MEP, and we had a TPA who felt that because they got clipped, that they were entitled to an extra $80,000 to do 5,500's evaluation, even though we paid an annual fee. And to me, that is one area that, again, I get fired. I'm not entitled to a fee. And I understand that there's work involved when a TPA deconverts, but I've seen just too many abuses. When I worked at a certain TPA that Bill remembers, the guy running the place would determine the termination cost based on who the advisor was. If the advisor had brought us, had brought Richie 20 plans, they'd pay less of a deconversion cost than if there was one advisor that only had one client with us. That to me is still that one abuse that the Department of Labor still hasn't, to me, all fees got to be disclosed. And I will always say, that is the one racket that to me is allowed left.
But shouldn't there be a termination fee in a contract, Ari? I mean, always? I mean, like
there is discussion about it, but the contracts that I've seen, it's always like there's no guesstimate, there's no fee. It's just like, well, and again, it's I always talk about the TV show The Real World. Everybody's nice until they're not, and TPAs are nice and professional until they get fired. I've seen too many instances where they take these things personally, and as Michael Corleone would say, this is business. It's not personal. James, what do you say?
Yeah, again, I'm not a huge fan of it in terms of, again, if you're being replaced, you're being replaced, then then you did something or you didn't do something. So therefore, trying to grasp onto something to make up for your own inefficiency doesn't seem like a business model that we would follow. No.
Okay. Yeah. Anybody else? Other changes in this business. I mean, when I started in 1998, the internet was becoming a thing, and they were moving all these plans to daily valuation. And in those days, you made your changes by telephone. And then I remember in 99 or 2000, we got our first website, which you couldn't even change trades. Technology is always changing the role of how plans operate. And of course, that also involves people losing their jobs. How do you think AI is going to play into, replacing some people's jobs in the retirement plan space? I mean, I've seen situations where now you have plan providers. If you want to, companies that want to switch over plan documents, they could use AI to switch over the plan documents to make it easier for people to restate plan documents. So how do you guys see AI changing the nature of the business?
I think for policies and procedures and documents, yeah, I think it can affect some real changes there. Anything that's kind of like stuff that's by rote, where it's just, and I'm not talking about customized stuff. I'm talking about like standard, you know, you know, you could take this policy statement and it doesn't look like it looks like every other statement. I think AI could have a role in that. I mean, the problems with the AI that I've had as the application to our industry are currency and bad information. A lot of times when I quiz AI on things in our industry, the information isn't always up to date. And then the second part of it is that the AI it learns eventually on the fourth or fifth try which information out there is good and which is bad. But a lot of times, if there's 10 things out there on a subject and five of them are wrong, the AI is going to pick it up.
Mhm.
And that's, you can't afford to really be wrong on basic things in our industry, or else you get laughed out of town. So I think it has it's very promising, and I think it has a way to go. But right now, I think in our industry, a lot of the application might be to, things where we check the box and the box is always the same check, that kind of stuff, where it's, like I said, a lot of like I could see it writing a good administrative manual maybe for a retirement plan, but going beyond like the stuff that really requires more than that. I mean, I think AI will get there, but I just like what I'm seeing of AI is not there yet.
No, and again, and then that goes all back to the point we were talking about earlier is, yeah, I mean, if the plan sponsor is looking for something they deem as easy and not involving people, then great. And there's going to be some, but not everybody wants to talk to a computer and punch in a bunch of information and be told what to do. People like to talk to people and who are engaged and can provide, that advice aspect to them. Yes, can documents be done? Can compliance be done to a degree? Yes, but again, do you want to risk your liability that the computer got it right? I mean, at some point, is it going to be, like Mike said, obviously getting better and better? Yes, but I don't. We see there's some. I'm sure you guys get them as well. I get emails all the time from these new portfolio managers who are going to make it easier because, it's like Monte Carlo on steroids or something, where they can tell you how you're going to, every day of your life, how you can retire with an extra. And I don't know if that's where we're headed, large scale. Do I think it's going to fit in some circumstances? Yes, but, well, certainly not in, I don't think, I think we'll all be retired before we get pushed out, personally.
So there won't be the Imagine account powered by AI.
At some point there probably will be, but I think it'll be my grandkids who are looking at it, not me. So
Bill, be interested in your thoughts. I think you probably have some thoughts on that, right?
Yeah, listen, I think we're in inning number one, maybe the top of the second in the AI, implementation and impact on business and society. So we have a long way to go before it realizes its potential. I haven't seen a lot of impact yet, but talk to me in 2 years, in 3 years, and that could change. I think, at least in the 401k space, it may not replace a lot of people, but the people that aren't using AI will be replaced. So it's a tool to make productivity more efficient and better and save time. So I think the human element will never go away. But if the human element, if the service provider isn't incorporating it, they'll go away. So it's going to be a partnership and a tool to be utilized, not a tool to be feared, from a business efficiency point of view. So I think the benefits will be phenomenal in terms of time saving, in terms of efficiencies. But to the points that have already been raised, you're crazy if you're going to trust something produced by a computer based on what's out there on the internet without human intervention and proofreading and double checking and making sure everything is the way it should be. So I don't see it fully replacing humans, but it's going to make the workload a lot easier and more productive.
We got about 10 minutes left, so if anybody has questions that we can answer, that that feel free. But we'll get to it before the top of the hour. But to me, AI, it's always it always reminds me. Again, I always talk about movies, and then my wife will complain that she hasn't seen these movies. But the movie's Back to School is one of my favorite movies of all time, and
Classic.
Jason is the son, and he's asked Thornton Mellon, he wants to buy used books, and Thornton Mellon says, why are you buying used books, buy new? And he's like, Jason's like, well, they've been underlined. And Thornton Mellon says, well, what if they've been underlined by a maniac? And
Exactly.
I wouldn't say the AI, information is fed by maniacs, but what if it's fed by people who don't know what the heck they're doing?
Yeah.
That's always the problem. So it's like, it's only as good as the information it's provided. And so if you had somebody, and I've worked with a lot of bad administrators in my life, when you spend 10 years working for TPAs and they get people straight from Stony Brook, my alma mater, and they gave them no preparation, nothing, no education, no training, and made them administrators, and those people never became good. They tell me that they allowed hardship distributions of earnings from deferrals when it wasn't even allowed up until recently. That sort of thing. There will be a role for AI, and it's like again, back in 1998, you couldn't imagine. You knew the internet was there because you were on it, and Netscape took forever to load and all that kind of stuff. But you knew that eventually, I don't think you foresaw a Netflix or all this streaming, but you knew the technology was there. And to me, the technology that AI will have, I think that it will change how TPAs work. I think a lot of the skills in terms of compliance testing probably could be simplified through AI. But of course, you will always need, human interaction and human oversight, because with anything with testing and compliance, I always say garbage in, garbage out. If you have garbage information that you're being fed by the plan sponsor, you're going to get a garbage result, and the compliance testing is going to be incorrect. So you're always going to need that. I'm talking that I see that it's going to increase productivity. For example, I've been doing plain documents 25 years now. I have not raised my prices in 25 years. Why? Because Relias has made it so much easier through the interface, and now I can do plain documents. I could email it back. 10 years ago, I used to have to go to Staples to get it bound. I no longer have paper, copies. Everything's done electronically. Technology, and like I said, AI is just going to me, is going to increase productivity and reduce reliance on people. You're not going to need the 4 or 5 people maybe in compliance testing anymore. Obviously, AI is not going to help, replace the advisor to pick out which funds to pick. I'll never see that because you're still going to want that human interaction. But I think that it's going to make, the industry more productive. But, with productivity and consolidation in this business, we always talk about consolidation. We never talk about the people that lose their jobs as a result of it. Bill, about consolidation, what that can do. People lose their jobs. Anytime you see a merger, all I can think about is who's going to lose their job. That's just the nature of the business.
Yep, it's going to continue. We'll see a lot more consolidation in the 401k space. You see it with the record keepers all the time. You'll see it on the asset management side as, the asset managers are under pressure because, the sales might be higher, but the revenue is down because of the evolution of CITs. They're less expensive than mutual funds. The profit margins are lower. On the retail side, you have the ETFs, coming out. So what was mutual funds and very profitable for the asset managers those dollars are still there, but it's at a much lower revenue yield. So it leads to an environment of consolidation, and you have private equity that's come into our space. You have a lot of the RIA firms, the advisory firms owned by private equity now. You have record keepers out there, especially on the the non-insurance side where there's private equity involved. So you will see consolidation continue. But private equity can also bring innovation. It could bring capital infusions to let providers innovate too. So to use James's term at the very beginning, it could be a double-edged sword. But we will see more consolidation on the record keeping side and the asset management side.
Agreed.
Do you see one of these days, or one of these plan providers, just Revenge of the Sith, the Order 66, where they turned on the Jedi? Do you ever see a situation where the large record keepers were just going to squeeze out the advisors?
No.
Yeah, I think that's that whole that human aspect of it in terms of, there's got to be a connection somewhere, because they're not just, no one is going to hire, because then you're just getting an 800 number, and now you've lost any type of connectivity, and I don't think it's ever going to be replaced that way.
And you just have to look at Fidelity as a model. Years ago, Fidelity was non-advisor only, and now they're one of the leading providers in the advisor space. They've learned to partner with the advisor. Yes, there's, they look for the individuals to have their brokerage accounts at Fidelity. Empower's doing the same thing, but they're not going to abandon the advisor. They're too critical to the American retirement system from the plan sponsor point of view and the participant point of view. To James's point, there's always going to be a need for a financial advisor to help guide the plan sponsor and, more importantly, the participant.
Agreed.
We do have, well, not a question, but a Q&A. A good friend of mine, ESG is often misunderstood. What it means is investing in congruence with the investor's beliefs and preferences. Could be Christian, Catholic, could be environmental. Even that could be multiple nuances of where your beliefs and environmental causes lie. In any case, ESG involves concentrated investments, which is the opposite of diversification. So it is not good as you are working with large and varied population. Suppose it's a Catholic school, then having an option that involves investing with the U.S. Catholic Bishop guidelines. ESG covers all ways of aligning your investing with deeply held beliefs. So which one? Just make sure you have diversification as your primary default. Proceed cautiously with ESG, and education is critical. Listen, I agree with that. That's I'm not one of those people who is like I said, I drive a Prius V. I'll drive that car into the ground. I'm all for environmental beliefs and all that stuff. It just, to me, I never understood it as having it as an investment within a retirement plan. It's just my
on the nature of that. I think that I'm glad that question, that issue was posed, because what I don't want to see, and I agree, Yari, but what I don't want to see is, church plans have been investing in faith-based funds for decades and decades and decades. Other 403B plans have been investing in what we used to call socially responsible funds, and now we call ESG funds, for decades and decades and decades. I don't want the government coming after that. I just don't.
Oh, again, and that's and I think that's to Bill's point earlier, is ESG and SRI are different, but to make it easy, everyone just kind of mashed them together, and it's and again, like to John's point, as long as you have the diversification and there's another option, then the person didn't choose what you offered, they chose what they wanted, and it's participant directed. So allow them. And like Mike said, I mean, for 40 years it's been going on, and nobody's complained, so it's
we've never had a suit as far as I know. I mean, it just, even, I mean, if those, if we've been litigating against 403B now for almost a decade now, if it was a big issue, don't you think Schlichter would have brought it? Somebody would have brought it up.
And well, again, and to Bill's point earlier, exactly. I mean, that Megan, you want to talk about a costly argument? that thing will get, there'll be 7,000 motions in that trial that lasts
And
for.
what's funny is
a
the
decade.
American Airlines suit is over ESG, but if you look at the case, there is not a single ESG fund in the American Airlines
Yeah.
plan.
Yeah,
Yeah.
It was because the asset managers they were using on the index options were voting the proxies in a
Yes.
way that aligned with ESG. So,
Yeah.
you know,
yeah,
now we're
there
gonna
was a
have to have
question of
fiduciary-
duty of loyalty. They breach their duty of loyalty, but not their duty of prudence.
Well, I would even push back against that because what are the fiduciaries supposed to do? Monitor all the proxy votes? I
Proxy
mean,
votes,
if you
yeah.
have an S&P 500 fund, that's 500 companies that might do 2 proxies a year. That's 1,000 proxy votes.
I think that case
What
is
is your
getting
committee
killed,
going
so.
to do?
Yeah.
Exactly. Exactly.
So anyway, we're at the top of the hour, and I don't want to intrude on Bill's time. So that's that. And until next time, we're gonna have to do this again more. Time got away from us. We used to enjoy doing this once every couple months, and we'll have to do this again. Okay,
All
great.
right, thank you, guys. Yep.
Appreciate
Okay,
it.
Bill, you got the screen.
Go ahead,
All
Bill.
right, so I'm going to share my screen and hopefully technology doesn't fail us. So please let me know when you can see my screen. I
You
think
started
it's
sharing
coming
your
up now.
screen. Yep, it's there.
All right, excellent. So my segment here is titled Anatomy of a 5500. And I know Ari is probably going to opine about the Houston Astros 5500 that I used to run around with when I was in the field and show advisors, my one-page bullet point summary that I would prepare for advisors to help them prepare for their finals presentation. So what I'd like to do here, and I apologize if the screen is a little cluttered, I don't know how to clean it up here. So I think it's fine the way it is. This is the actual New York Mets, or formerly known as the New York Metropolitans, Major League Baseball 401k plan for the employees of the Mets. It excludes the players or any collectively bargained employees, but we'll get to that. So if you're an advisor and you're looking to prospect, if you're looking to prepare for a finals meeting, or you just want to get some information about a particular plan, the website is efast.dol.gov. And you just come right onto this site. So let me refresh that a little bit. And it will bring you right here to the Department of Labor website. And all you have to do is click Form 5500 search. And then you could search by plan name. You could search by plan sponsor name, because sometimes the plan name is different than the plan sponsor. But the most effective way is if you have the tax ID number. And you just pop that in there. So if you were looking, so we talked about the Houston Astros, you would just type in Houston Astros. And you get 29 results. And then you just click by plan year, and then it sorts by plan year. And you'll have the health insurance plans, which we talked about being covered under ERISA, and the 401k plan. So I did this for the New York Mets. So let's walk through this in the next 28 and a half minutes. So you have here, what I look at, and I highlighted some of the key things. So first thing I look at is it a calendar year plan? And you can see right up here, January 1st to 12/31. Then I look at the 3-digit plan number. Is this the only plan out there? Is this the original plan? And you'll usually see a 3-digit number, 001, 002. So what this tells me is this is the second plan that the New York Mets have ever offered. Now, is plan 001 still out there? Well, we would go back to the DOL website and see maybe it was a defined benefit plan, a cash balance plan. Maybe they had a 401k and a separate profit sharing. You'll see this in the ERISA 403B space where they have a 403B and a 401A. One will be 001, the next will be 002. In this case, there was no other plan out there. So they may have had a DB at some point that they terminated, or another 401k that they merged into this one. Not sure. Effective date of the plan, this plan started in 1988. It doesn't mean they've been with the same provider since 88. This is just how long this plan has been in existence. Then you have the industry code. So if, let's say, for example, the plan sponsor's name here is much different for some reason than the name of the plan. So I don't know what QBJV Holdings is. There's no way to tell by that name. So you can actually go by the industry code to see what type of business it is if you're not sure, and I'll come back to that. Who's your main contact? Right here, William Lockhart. What date was the filed? Like most 5500s, they waited till the last minute to file. We go on to the next page here, and this is where you can calculate participation rates. So I'm going to walk through this and do a little bit of math. So when we look at this, you have total number of active participants at the beginning of the year and active participants at the end of the year. Obviously, I want to use the most recent data, so I'm going to look at end of the year. And again, this is the end of 2023. This 5500 was filed on October 15th of 2024. So the information here is almost 13 months old. But active participants doesn't mean actively participating. Remember, this is a government form, so it doesn't make sense. Active participants in the eyes of the Department of Labor is an eligible employee. So the New York Mets have 599 eligible employees at the end of the year. Now, in the plan, there are 7 people that have a benefit in the plan, and they're retired or separated, and they are receiving benefits. More than likely, this is somebody taking required minimum distributions, could be periodic payments, but they're actively taking withdrawals out of the plan. Then you have retired or separated participants entitled to future benefits. These are terminated employees or people that no longer work there that have a vested balance in the plan. And then you have a deceased participant whose beneficiaries have a balance in the plan. So I'm in the Invesco 401k, I pass away, my wife is my beneficiary. She would be listed here as one of these numbers if the money was still in the Invesco 401k plan. So now how do we calculate participation? Well, we look at the number of participants with account balances at the end of the year, and that's 772. From that, we know one of them is a beneficiary, so we subtract that person out. We know 7 of them are currently receiving benefits on a periodic basis. We back them out. Then we take away the 181 terminated with balances, and we back them out. That leaves 583 people with balances that currently are working there. We take the 583, divide it into the 599, and you arrive at a 97.4% participation rate. So now that tells me 2 things to look for. 1, is the plan doing automatic enrollment? And you can tell that by these pension codes on line 8A, 2E, 2J. The code for auto enroll is 2S as in Sam. I don't see it here, so it doesn't look like the plan's doing auto enroll. So what other situation is there when almost every eligible employee has a balance? And that's if the company is doing a profit sharing plan, where everybody that's eligible gets a contribution. So chances are, I doubt without automatic enrollment that 97% plus of the employee population is making salary deferrals. That's very unlikely. So it's more than likely that this company, this plan, is doing profit sharing. So we'll footnote that and hold it aside, and we'll see if we can find that later. Then I look at this area here, plan funding arrangement, and I just look to see if there's an insurance carrier involved, because that could be a group annuity plan, it could be a frozen GIC, it could be life insurance policies in the plan. It's just something to say, okay, there's some insurance component, I'll put that in the back of my mind, and I'll come back to it. Then we go down and we get into the schedules. Schedule A is if there is insurance, it has to be listed here. Who's your insurance carrier? And I see it's New York Life. And I see there are 7 people out of the 599 eligible, or the 593 with balances. There's only 7 that are invested in the insurance component. So that tells me it's one of 2 things. Either it's individual life insurance policies, which to me is a very good retirement plan for the person selling them inside of a 401k, or it's a frozen GIC. They were with New York Life years ago as their 401k provider. There was a surrender charge. They froze it. And now the results are de minimis. There's only 7 people left in it. So it's something we, again, put those 2 things on the side and we look to explore further. But it's not a very high number of people. So it's just a piece of information to go on. Then we get to the fun part. And the fact that I consider this fun is probably a sign that, you know, I need to have a better social life. But we get to the Schedule C. And the Schedule C was the very first form of fee disclosure. You know, we know ERISA 408B2 and the fee disclosure requirements came out in 2012. This predates that. The Form 5500 requires any fees coming out of the plan to be disclosed on the Schedule C, or any service provider receiving compensation, if it's direct or indirect, to list their compensation on the Schedule C. So let's see what we have here. Well, we have Fidelity Investments. So right now I'm thinking Fidelity's their record keeper because they're listed right here as the primary service provider. We then go down, and you can see it's a government form because there's a lot of wasted space. It's not very efficient, but you have to go through this. Then I see Fiduciant Advisors. So this is the plan's consulting firm that's providing consulting services. Now, what's the scope of those consulting services? No idea. It could just be, you know, from a investment monitoring point of view. It could be a participant education point of view. It could be both. It could be 321, 338. We don't know. It's not very much, it's not spelled out completely here. Sometimes you will see much more detail, but we can tell from here that Fiduciant was compensated in 2023, $35,525 directly from plan assets. It says enter direct compensation. When it's direct compensation, that means it's being debited from participant accounts. They will see it on their statements. It's a direct fee impacting participant balances. If it's indirect, the participants don't see it on their statements. It's part of a fund expense. You know, the expense ratios of the fund might incorporate it, but it's another party paying that provider, not the plan assets directly. You know, if you have money in a fund and the fund is paying it, the participants pay the fund and the fund then pays the provider. It's a little circuitous route. I had trouble with that word. And the fund is paying the party, not the participant directly. Then you have the auditing fee. The audit fee for this plan is $25,700, and Baker Tilly is the accounting firm. Then we confirmed what we thought earlier. Fidelity Investments, record keeper right here, $14,936. Now, for a plan with, you know, 500 and well, actually over 700 participants, because that includes the terminated, 14,000 seems really low. So that doesn't mean this is all they're paying for record keeping. It means that maybe the company is writing a check to Fidelity, and this is covering participant initiated fees like loan fees, distribution fees, you know, something like that, but we don't know. It's just an indication that there was almost $15,000 taken out of plan assets that will show up on participant statements for a variety of services. Loans, distributions, trustee fees could be in here, record-keeping fees of some sort. But to think that this is all the compensation Fidelity is receiving is probably premature. So let's go down a little further. Oh, now we see funds listed, okay? So you have the AB, AllianceBernstein Small Cap Growth Fund here, and they're paying Fidelity 50 bips because they're paying 50 here. And that's revenue sharing. And I know Ari loves the term revenue sharing. Sub-TA fee, sub-transfer agency fee, but this fund is paying Fidelity 50 bips. Then we go down, we see this fund is paying 40 bips. This fund is paying 25 bips. BlackRock, again, 25, JP Morgan, 10. So I have different funds paying different amounts. Now, revenue sharing. If Fidelity is just saying, we're keeping the revenue, have a nice day, we're only going to charge you $15,000 a year, that is something that you should bring to the plan sponsor's attention and say, listen, Fidelity was happy charging you $15,000 a year when you were a $10 million plan because they were getting revenue from the funds. They were thrilled when it was a $20 million plan. When it was a $30 million plan, the balloons and confetti were falling from the ceiling because as the assets go up, their revenue keeps going up. So that is something that shouldn't be occurring. I mean, there's no legal basis to say it shouldn't be occurring, but it's not a fiduciary best practice because your record keeping fees should not be based on assets. The record keeping function is based on the number of participants. That determines the workload. Whether if it's a 100-person plan with $1 million in assets or a 100-person plan with 10 million in assets, the job of the record keeper doesn't change based on the number. So their revenue shouldn't be predicated on the amount of assets. So this is what happened with 408B2. You can go to the plan sponsor and say, listen, we see you're getting revenue from the funds. Either rebate it back to the participant from which it was generated, or utilize it to pay plan expenses. So we don't want to have, so you either don't use revenue sharing at all and you use clean shares, the R6s, institutional, that don't have any type of revenue. But if you are using revenue sharing, you want to make sure that it's going back to the participant that generated it to arrive at a net lower fee, because you can have a fund like in the Y share or an A share that has an expense ratio of 100 bips, and you rebate the revenue back to that participant. So in an A share, it's typically, not always, 25 bips of 12B1, 25 bips of sub TA. So an A share typically will generate 50 bips of revenue. So if the fund expense is 1.13 and you're rebating 50, the participant can get that fund for 63 bips. That might be cheaper than the R6 in some instances. So you can use revenue to arrive at a net lower share class, or you can just say, you know what, I don't want to get involved in rebates and collecting that revenue and then rebating it right and trusting the accounting process is correct. Let's just go to clean shares. In this situation, we don't know what they're doing with the revenue, but you have a situation here where different funds are paying different amounts. So if they're not rebating the revenue, the person in the AllianceBernstein plan is subsidizing the plan at a greater degree than the person in the BlackRock fund. It's like I bring in lunch, put it in the fridge, and you come in and take a bite out of my sandwich. Hey, thank you very much. You helped my lunch today. No, we want revenue to be level across the board. So be very careful if you see different amounts of revenue being paid here. You want to ask, how is that revenue being utilized? Is it being rebated back to the participants that generated it? If not, you may have some value to add to this client. So we'll come back to that. So then we scroll down and we get to the financial. There's some notes here. So if you ever see termination information, that's because they changed a TPA, an advisor, a record keeper, and they'll state the reason. So in this case, the auditor stayed the same. They just came up with a new tax ID number. So that's noted here. So any service provider changes will typically be noted there. Schedule D is for any non-mutual fund investments. So CCT is common collective trusts. Pooled separate accounts is PSA, master trust investment accounts. So anything that's not a mutual fund will be listed here. And here you have the New York Life stable value. So there's our insurance. It's not individual life insurance contracts. It's a frozen GIC or a frozen stable value that, because there was a surrender charge or a market value adjustment, that they just froze it in the plan, and participants, it's participant responsive, so participants can take money out without any penalty, and there's still 7 people left in there. And then now they have the Fidelity Stable Value Fund. So that question is answered by looking at that. Then we go down to the financials, and that's the Schedule H. And I just go right to page 2, and this shows net assets. So let me go back up here. So you have beginning of the year and end of the year. So of course, I want to look at end of the year. So before I do that, I look down and I see, oh, they have participant loans. So I know the plan allows loans. Okay, so that's just one indicator. Hey, does the plan? Yeah, you can see the plan allows loans because there's a dollar amount here. Now I go down to the financials and I see the New York Mets 401k plan as of 12/31/2023 was just shy of $63 million with 700 odd participants. 583 are still working there. With 599 eligible. So very good plan, nice average account balance. Who put money in? Well, the participants in 2023 put in $5.1 million into the plan. So good participation rates, healthy, contributions. The company, the Mets, 3.1 million in the plan. Now, was that a match? Was it a profit sharing? Was it both? Well, the early indications were that it was profit sharing because almost everybody that was eligible had a balance. So that tells me profit sharing is more than likely being utilized here. But was there a match? We don't know. There's participant loans again. So you go down here, you'll see all different lines. I highlighted the key ones. Then we look at expenses. So here you can see how much money went out of the plan. So you have 4,111,481 that went out directly to participants. So these are people that pulled money out of the plan, whether it be a rollover, whether it be a lump sum distribution. This was money that was paid out to participants. I don't really agree with the format of the form that's an expense, because it's not an expense. It's just participants taking their money. But on the balance sheet, it's a debit to plan asset, so they list it from an accounting point of view as an expense because it's a negative to plan assets. Then you have two things here: corrective distributions. So corrective distributions can be one of two things on the long form 5500. On the short form 5500, it could be one of three things. I'll get to that. So a corrective distribution on the long form 5500, which is what we are looking at, could either be failed discrimination testing, and you're rebating that money back to the highly compensated to bring their average down, or it could be a refund of excess deferrals if anybody went over the plan limits or the IRS limits for salary deferrals. And you do the corrective distributions at the beginning of the year for any excess salary deferrals or anybody that exceeded the IRS or plan limits. Given that there was 5 million in company and employee contributions, I'm leaning towards this wasn't failed testing. That only $5,000 was refunded to the highly compensated to correct the failed test. This is probably a couple of people, that went over the 402G limit with their salary deferrals, maybe because they worked somewhere for the first half of the year, they joined the Mets and contributed the second half of the year, and nobody married up the two amounts for the year, or some other reason why somebody went over the limits. In a short form, the corrective distributions and deemed distributions are combined onto one line. So it could be refund from a failed test, it could be refund of excess deferrals, or it could be defaulted loans on a short form. So those two are combined. So you really can't tell unless you can ascertain if the plan doesn't allow loans and you see it, then it's corrective distributions from a salary deferral point of view or highly compensated. So the fact that we have deemed distributions tells me that there were defaulted loans. It's only $3,000, $4,000, so that's probably one person with a defaulted loan for the year. Here, ideally, if the 5500 is pristine and 100% accurate, everything that was on the Schedule C in direct compensation will be listed here in terms of fees that are directly coming out of the plan. And if you remember, fiduciant's fee is here. There's the auditor's fee. And for some reason, I think Fidelity's fee is different here by $4. I'm not sure why. I think it was $936 on the Schedule C. It's $932 here. And then I always look for, hey, was there a merger, a spinoff? Did anything merge into this plan? Did they make an acquisition and absorb another plan? And you'll see that here, transfer of assets to the plan or from the plan. So those are the key indicators on the financial component. Then you get into the compliance questions. And the two I always look at are failure to transmit to the plan any participant contributions within the time frame prescribed. Yes, so they were late on salary deferrals. Up goes the audit flag. This is what the DOL looks for. If they're not doing this correctly, what else aren't they doing correctly? That's an audit flag. Same thing with the fidelity bond. Do they have a fidelity bond? If this is blank, they're not going to come in and fine you, but the audit flag goes up to a degree. Hey, if they don't have this in place, what else do they don't have in place? And the requirements for a fidelity bond are, 500,000, 10% of plan assets, or $500,000, whichever is lower. So the Mets only require a $500,000 fidelity bond, yet they have a fidelity bond for $17.5 million. Fidelity bonds aren't that expensive. Again, this isn't fiduciary insurance. This is a fidelity bond to prevent fraud and embezzlement. And the Mets actually had to utilize this back in 2008 because they had a portion of their 401k with Bernie Madoff. They had a fidelity bond in place that covered the participants for some of the assets that were with Madoff, not all. So that might be historically why they, they might have some scar tissue, and their fidelity bond is very excessive. They just were traumatized, 15 years ago or so with this. So that could be a good reason why. But you could probably save them some money by saying, hey, your fidelity bond is a third of plan assets. You really don't need to have it that high. Then we get into the audit. The Schedule R has no meaningful information, and I have 6 minutes left, so we'll skim through the audit. This is the full audit. You go onto the DOL website and you get it here. The first few pages are the accounting firm telling you that they're not responsible for anything themselves. They're just as good as the information provided. So that's the accounting disclosure. And then you go down and you get a description of the plan. And established in 1988, nice little summary. But here they give you the eligibility. The plan covers all employees who are 21 and older. Okay, so there's the age requirement. Do they have a service requirement? Well, they don't jump into that. Now they tell us who's excluded. Okay, employees that live in Puerto Rico, anybody covered by a collective bargaining agreement. Then they, those who are minor league baseball players who are covered by a collective bargaining agreement. And those who are seasonal employees or paid on a per day or per game basis, unless they work 1,000 hours. Now we know under the Secure 2.0, there's the long-term part-time rule. So this might be something they need to monitor differently because their audit is saying 1,000 hours. We know that rule changed to 500 hours, and 2 years of service. So this is something they need to be made aware of, that they need to monitor their eligibility differently going forward. Contributions, yeah, pre-tax contributions, we see it. We see they have a Roth feature. We see they allow catch-ups. This was a bit odd because I've never seen that the employer is obligated to contribute a matching contribution. I usually see the employer may contribute, or will contribute, or at its discretion contribute. So I've never seen the word obligated because that makes it seem like it's mandatory. And I don't think the document will have it listed as mandatory, especially
if they have a stated match, which I hate.
Yeah.
Which I hate.
Yep. So here it's 50% on the first 6% of pay. So very competitive match. That's in fact the national average. So you have a 50% match. Then you have a fixed percentage employer contribution of 3%. So all employees are receiving 3% of pay. There's our profit sharing. But wait, 3% to everybody. That sounds like a safe harbor, or it could be a safe harbor. So is it a safe harbor? Well, we have to look at the vesting schedule and see. Vesting. Participants are immediately vested in their own contributions. Okay. Employer matching, the required 3% fixed and discretionary are vested on years of service. So it's not a safe harbor because otherwise it would be 100% vested. These amounts become 100% in 20%. So they have a 5-year graded vesting schedule. We go down, forfeitures. Forfeitures will be used to reduce company contributions and pay plan administrative expenses. So they're giving the employer a choice. That's, if this was a $600 million plan, this could be a target for litigation because to pay plan expenses would benefit the participants more so than reducing future company contributions. So here's some squishy language. So if this were $1 billion plan, I would advise the Mets, pick a side, pick one and only one and put it in there. And they have 2 options here. One favors the company, one favors the participants. So they don't have may or whatever. They're saying they're going to do both. Sometimes they may not do both. If they offset company contributions and there's no money left over to pay plan expenses, so that's the thing. But that's clearly indicated here. And then subsequent events. This is since 12/31/2023 through October 15th. Was there any major material event to the plan? And the answer is no. Maybe they changed service providers, whatever. That didn't happen. And then finally, we get to the bottom and the last page of plan termination. Is the plan going to terminate in the coming year? No. Was the plan terminated? No. It's within their rights to do so, but they have no expressed intent to discontinue the plan. Then we get to the last page, and that is a list of the investments with balances. So you can see, where the money is, how much, if the bulk of it is in target dates, which it looks to be, do they have a good mix of active and passive? And they do. Any major underperformers, you can load these into FI 360. And I'm not going to opine on the quality of the investments, but you can look and do a full review. And there's your 62 million participant loans, the New York Life, a CIT. If you would like to get a guide to this, you can send me an email and we will send you this. And I'll give you my email address as I have a minute and a half left here. This is a piece on how to review a 5500. It talks about what to look for. It covers a lot of the things we just walked through. But more importantly, remember those pension codes when I was talking about auto enroll? They're all listed here. So this is the secret decoder ring. Are they doing new comparability or cross-testing? Is it a money purchase plan? Profit sharing? Do they intend to comply with 404C? Is there auto enroll? Is there a QDIA in place? It even goes down now to include the new one, the newest pension code is there a PLESA, a plan linked emergency savings account? So all the pension codes are listed here. Are there brokerage accounts involved? And then we talked about the industry codes. They're all listed here numerically. So if you would like to get a PDF of this, shoot me an email. My email is William, because we're formal here at Invesco, WILLIAM.Schories, SCHORIES @Invesco.com. So pretty plain and basic. William.Schories@Invesco.com, and we'll get you out this PDF. Again, no product, no funds, just a strict interpretation guide to the IRS Form 5500, which, when you think about it, is a misnomer because this doesn't go to the IRS. It goes to the Department of Labor. So that's it. Happy to take any questions for a minute or two. And I know we have our next speaker geared up, so I want to be respectful of his time as well.
Yeah, here just is a 5500 form required if the plan is non-ERISA? The answer is no. If it's not ERISA, except if you're a like, for example, owner-only plan with more than $250,000, theoretically, you're not ERISA, but you have to file a 5500. This is a great session. Explanations. Hope a recording is available. Yeah, John, they'll be up on YouTube later today. Each day will be on YouTube. And he'd love to listen again with a 5500 in front and in front of him and all that stuff. Okay, that's it.
Okay. Thank you, sir. Thank you, everybody.
No, thank you, Bill. Always fun. I knew somebody whose aunt worked for Wilpon, I think at Sterling, and he did push people to invest their money with Madoff.
Yep.
So I think she was made whole. But anyway, our next speaker, Paul from 401Go. How are you?
Hey, Ari. All right. Thank you.
You got the screen? Okay, you go away.
I was hoping it would work.
Yeah, it works. I see it.
All right, fantastic. Well, Ari, thank you so much. I appreciate the opportunity to speak to the group and excited to share what is going on at 401Go. So the topic today that I'll be sharing with the group is the small market, in our opinion, has become the big market. So again, the landscape continues to change, and we think that we're having an impact that is a great opportunity for our financial advisor partners. So again, we'll kick this off. And, with everything changing, there's some topics that continue to kind of surface and will continue to surface, right? Regulatory instances continue to kind of push the small market in front of the advisor community more than ever, with Secure 2.0 and versions to come, and state mandates as they continue to grow across the country as well. Those changes are increasing, making it very attractive for, small business owners that maybe have ignored the planned space prior to be able to start a new plan. No better time than to start a plan now if you fit that category. And there's just so many those types of plans or companies out there that need to take advantage of this if at all possible. A tight job market. The 401k has become a leading job benefit that, every employee is looking for. And obviously, the smaller you are, the tougher it is to implement and compete with bigger companies for those benefits. And we're trying to have an impact on that. Small business owners, again, I don't know when it happened, Ari, but the industry has really asked the business owner community to become ERISA experts. And I don't think anybody signed up for that except for us in the industry to some degree, right? So I think we can help.
They're, they're more educated than they used to be. I mean, back in the late 90s, if you explain to them, they just, or even at the beginning of this millennium, they just tuned you out.
Yeah, without a doubt, right? Smarter business owner across the board, but still, can be cumbersome in becoming that expert. So they need our help. And more, this section of the space really, I think, would benefit from, the expertise that our industry has. So what does it look like? And these numbers, I think, are repeated. They come out on a very regular basis now, but there are 6 million small businesses in the U.S. before mandates, and only a small fraction of them actually offered a retirement plan. So there's a tremendous market out there that's been overlooked for a variety of reasons, which I'll touch on today. But, it creates a tremendous opportunity for, I think, the advisor community to be able to step in and really help support their clients with, a better solution than maybe what's been in place up to this point. Businesses want 401k plans in place. Their workers are asking for 401k plans to be in place. And, they don't want a watered down version that, unfortunately, I think is what has been presented across the board in a lot of cases. The smaller you are, the poorer the product was that was available, and typically more expensive. So again, I think that the time has come for the retirement landscape to change and really lean into this space that's been overlooked and underserved for so long. So, tax credits, again, I think make it very attractive for small companies to start to look at, a qualified plan as a employee benefit. Depending on the makeup of the plan and where they are with regards to an existing plan, if there's one in place, I mean, there's different qualifiers for these tax credits that we can take advantage of. And we'll definitely help, our clientele at 401go to be able to really understand, how these credits can help support their plan startup at the very beginning and really grow that plan to a true benefit for their employees, making their employees happier, making their company happier, and really having an impact. Everybody deserves a modern retirement plan, no matter what size company that they work for. And that's really, I think, our goal at 401go, to be able to help really solve an issue that's been an ongoing problem, I think, in the space for a very, very long time. And happy, again, to review this on a case-by-case basis as needed. So how are we helping? And, I'm not sure, I'll give you a quick overview of 401go. We are the new kid on the block, a fully bundled turnkey record-keeping platform. So, we were an idea in 2017, sold our first plan in 2018, and fast forward to today, I think we're making getting some attention in the industry on who we are and what we're doing. So what makes us different than the traditional or legacy record keepers out there? Well, I think first off, we've built our own proprietary record keeping system. So the record keeping technology that we have is all ours. We control it, we build it, we enhance it, we grow it. And I think that really gives us an advantage to be able to have flexibility across the way that we service our plan clients. We've automated and integrated every possible piece that we can. We integrate with over 100 payroll partners, with 50 of those being API or true retirement or true integration, real-time integration. We have a API with our plan document provider, which allows us to do things that a lot of the industry can't do, which I'll share in a second. And then we have an integration with our custodian, which also allows us for efficiencies. So, you know, been doing this for a long time now. And, you know, I always talk about my own industry baggage. And one of the things that really stood out to me with 401go, obviously technology is changing every industry. And, you know, I think with regards to the 401 record keeping space, you know, there's been things that have been done the same way for a very long time. And one of them that stands out with the integration that we're making available to everyone that we work with is that, you know, that integration really creates efficiencies to manage plan business much faster and quicker and cleaner than ever before, in my opinion. We're able to actually set up a plan in 15 minutes with that integration with the plan document provider. So in the past, you know, it would take me, in my experience, 6 weeks to 6 months to stand up a plan. And I think, you know, one of the issues that we deal with on a regular is that, you know, every plan at most of the providers is treated the same way, whether it's a small plan, a medium plan, or a very large plan. The process is very cumbersome and takes, in most cases, weeks, if not months to set up. And I think with our automation and integration, it allows us to be able to create efficiencies for our advisor partners to be able to manage these plans in one meeting as opposed to weeks and months at a time. So I think that really, really stands out with regards to our approach to the industry and how the efficiencies that we're bringing to market are very different than I think what the industry is used to. Fully bundled, so turnkey bundled solution. We do the record keeping. We've automated all of the record keeping that we can. We offer a full 316 on all the plans that we participate in. We have flexibility around the 338. We can offer multiple 338 options on our platform for our advisors that are looking for that type of solution, and or for our advisors that are looking to build their own models. We have integration with the custodian, and you can build your own models on our platform, and we can manage that as well. So a ton of flexibility, I think, also stands out when you compare us to some of the other fintech record keepers that we get compared to. We offer a tremendous amount of flexibility around the software, number one, plan design, fee structure, and so forth. So again, 316, 338, and then allowing you to do the 338 if that's your preference. So a lot of flexibility. We can accommodate small business, solos, startups. Again, our mission statement is to offer everything, a plan to everyone, no matter what size company that they work for. But on that same note, our advisors are pulling us up market. So we're doing larger and larger conversion plans, and we can actually also accommodate cash balance plans. So I think we're doing a very good job of modernizing some, you know, typically messy partnerships with regards to the cash balance segment. It's all in-house, and we're able to handle that in a very modern way. You know, we also do it, I think, you know, with some efficiencies in pricing, you know, so advisor-led plans are $125 a month. We do have preferred pricing once you reach a 5-plan level with 401go. So again, very small commitment, and it works quite well. And please keep in mind, on top of this pricing structure, that you know, we customize every plan over $1 million and over 100 participants. So this pricing structure wouldn't fit for every single opportunity that we're starting to engage with, but this is our starting point. It's very transparent. Again, we're trying to make it very, very fee friendly on top of tech forward with a service model overlay. And I think that combination really stands out in the industry today, especially when we look at plans and commit to plans no matter what size. I think the other thing that is important to share is that we have a very strong service model. Every single plan with 411Go with at least one participant, so not solos, will get a dedicated relationship manager. So again, really, really servicing these plans. You know, in 2025, everybody wants technology, which we think that we're leaning into as well as anybody in the industry today. But I think the other part that cannot be overlooked is the people part of this. So we have committed to the service model that we put out there and receive very, very strong service scores on how we take care of our clients going forward. Again, industry baggage. In my past, it would be very, very cumbersome to set up a plan. But today, we have the software to be able to set up a plan in 15 minutes. So again, compared to weeks or months with legacy providers, we are one of the most efficient providers in the industry. So, you know, I've seen it happen and really, again, impressed with our approach. But, you know, we sit down with a advisor partner, meet with a plan sponsor or business owner, and we have a meeting virtually or in person. And literally we can generate a proposal in that meeting real time on our software. And then if they agree that it makes sense for their company, we can actually go ahead and run through the plan setup in that same meeting and go ahead and get all the documentation signature ready for the trustee. They can electronically sign through DocuSign, and then we'll go ahead and that will trigger and assign a transition person with 411Go, and they'll take over at that point. And again, really, really structured to be efficient and much more easy to manage and scale the small end of the market that, again, has been underserved for so long. Now, the technology, again, has continued to make impressions with our advisor community, and they are continuously moving us up market because, again, frustration with record-keeping technology is not just in the small end of the market, it's across the board, and I think we can make an impact there. Again, enjoy flexibility plan design. We have a lot of flexibility with regards to the plan design that we can offer. So again, very, very flexible with regards to the way that we can approach plans and make sure that they are set up in the best fashion that they can be set up.
Paul, there's one question. What is the maximum number of participants that your business can serve?
Great question, Ari. I mean, right now, our largest plan is 3,000 participants. So we haven't, I think, had to address it further than that. But, you know, it's really software. So, you know, headcount really isn't an issue for us.
Great.
Hopefully that answers the question.
Oh, it answers the question from the audience.
Fantastic. You know, complete on the client's behalf. Typically, when we get a green light, you know, our advisor has a meeting with one of our internal folks. We go through the plan design and the needs of the client and set it up and get its signature ready for the trustee. So again, very, very streamlined process that has been very well received and continues to get rave reviews. Again, we're a technology company more than we are a record keeper. So one of the things that was really front and center with our founders, you know, a small bit on that, you know, we have 3 founders. They came out of international logistics. They had a small company of around 50 people, you know, prior to starting the idea of 411Go. They were frustrated after a couple attempts. They didn't really think that there was a small plan product out there that didn't frustrate them. So they revisited it again in 2017 and really, I think, started to build something different from the rest of the industry. And part of, I think, what makes us different than most of the rest of our competitors is that from square one, we weren't built as a direct product. We were built, our software, our technology was built with the advisor in mind. So one of the founders actually has a TPA background. He was a family friend of the other two founders and really picked this apart to make sure that it worked for the advisor community. So again, that's really the reason that I think we stand out. And I believe that that is the reason that we continue to kind of capture more and more advisors that are looking for a more modern solution in the record keeping space. So part of that build was building a very, very strong advisor portal. So you have a plan monitoring dashboard that keeps all your book of business with 401go front and center with you, where you can actually view and look and review every single plan, every single participant, every single investment in your plans, and you can manage and monitor everything from that dashboard. And again, giving you access to each one of your clients in a very deep way. Custom fund lineups and models. Again, if you're looking for and want to build your own models, they're very easy to do with regards to changing those and updating them and so forth. Again, really strong custom fund lineup and model connection with our custodian. I think the other thing that really stands out with us as a pain point over the years is friction-free billing. We can accommodate hard dollar fee with basis point fee or a combination of both and collect it on your behalf. So again, I think that we really have made it easy for our number one client, the advisor, to actually get paid their fair compensation when they do these plans. So it keeps an ongoing ledger of your billing with us. So it's very easy to monitor and manage as you continue to grow business with 401go. On-demand client proposals, I think I mentioned it. We have a proposal generator that allows you to edit what page or what pages you want, what information you want on those proposals. And you can go ahead and update all your firm information onto that proposal, and really in real time, you can generate proposals on a very quick manner. Now, we are software, but we're here and we have people in place to help support that software. So we will support ongoing, initially and ongoing, as much as you need to make sure that you're comfortable with our software. But what happens in a very, very quick time is our advisor partners get comfortable with that software and start to generate business on their own. So again, we believe that's the future of the industry. And, we can do both. We do both today. I think we do both very well, but we're starting to see a huge uptick in advisors writing business with 401go and not ever actually having a real conversation with anyone at 401go. Here to support and service, but the technology, our dev team is very, very adamant about if we're having issues, especially service issues, that means our technology is not that good. And I think really our results kind of speak for themselves. A wide selection of reports. There's already a very large library of reports available for all your plans, but if it doesn't exist, we can absolutely build it. And then again, ongoing integrations with TAPS, and we'll continue to grow integrations to continue to build out a modern 401k platform, which I think is what the industry is looking and asking for. Service, I think a knock on the digital record keeping platforms today is service. It's all automation and not relationship. We built it with the intention of maintaining the relationships. Another saying at 401go is we've automated everything but the relationship. We know that this is a relationship business. 80% of our business is tied to an advisor partner, and we're committed to that because we know that plans with a advisor attached to it makes it a much, much stronger plan. So how do we help our advisors with that commitment? We're servicing those plans to help them be able to scale and manage and focus on their core business, whether that's building more plans or their wealth management practice or their insurance practice. We think that we can help specialists really scale and manage if they are a volume shop. If it's an advisor that's not a core retirement plan advisor, then we believe that we have the software in place to be able to give them the confidence that they can offer this plan to their clients. So you could be an expert or you can be new to the space and trying to grow it out. We think that we can provide you with the efficiency to be able to do that. And by the way, not only technology, but we'll service it on the same at a very high level to make sure that we maintain those relationships on your behalf. Secure 2.0 is making changes. So today's 401k is going to look very different, the 401k of the past is going to look very different in the future. And we want to make sure that we continue to stay front and center with regards to those changes, whether it's Secure 2.0 or just industry demand. As different things come to market, we're exploring everything to make it a very flexible platform for all our advisors to have access to their requests and what they're looking for to be able to help their plan sponsor clients, and obviously at the end to help the participant. We always understand that if we help the end user, the participant, then everyone else tends to be very happy with the results. So again, we talk a lot about Secure 2.0. Happy to talk or answer any questions that might come about. But again, we're prepared for it, and we continue to dive into it to make sure that we're ready for the changes that come. Hidden assets could pay big. One thing that's always stuck in my head with regards to the small plan space is that it's interesting, talking to advisors over the years. I've heard it once, twice, 10 times, but advisors, very successful specialist advisors, remind me that, they never overlook the small end of the market, because in most cases, with a lot of them, their largest client today was a startup, was one of their startups. So tremendous potential. Obviously, just like even conversion plans, you don't want every plan, you want the right plans. And if a small plan is projecting growth, then that makes sense to probably have a conversation with them. But again, I think simplicity and the efficiencies that we're able to create really allows our advisors to be able to step into this space with confidence. We win together again. Why the landscape continues to change. And, one thing I'm very aware of, doing this for a very long time, I think advisors are very aware that, the new toy has come to market previously. And, in a lot of cases, they've seen that new toy break. Well, I think we've hit a stage or a level where we're really starting to break out of that and really getting the attention of the industry across the board. And a big thanks to our advisors as they continue to promote us and refer us and use us. Again, not just in the small plan space. Our core footprint today of business is startup to about $5 million, but we've seen a huge uptick in that above that market, that 5 to 25 space over the course of the last 12 to 18 months. So again, I'll let you form your own opinion, but again, we're very proud of our technology today, and we know that it's going to continue to grow as we move forward. So
I got a couple of questions from people.
Shoot.
Number one, who is your custodian?
Matrix.
Great. How are we planning to handle student loan match, especially the validation of the repayment?
Yeah, great question. And I mean, again, I think we're exploring how we're going to do that. So that's a question for my dev team. I'm happy to share with them and get more details to get that question answered. But we're looking at all of that as we speak to make sure that we're prepared for it.
Yeah, okay. If someone has a large business, if Secure 2.0 is in place and is targeted for small business, how can your company help a larger business adapt as a client?
Well, I think the problem with the record keeping industry as a whole, and large, small is different for everyone, but it's just software. So again, we have the capabilities to be able to support larger plans, and we are supporting larger plans. We're already having dialogue with some very substantial plans. So I think we're going to see that change. We're already seeing it change, and we're preparing for it.
Okay, great. Thank you, Paul. As always, hope to see you soon.
Yeah, Ari, appreciate it. Anybody can reach me at the following contact information. Would love to have deeper dialogue. And if we're not connected on LinkedIn, would love to connect on LinkedIn. So Ari, appreciate it. Have a great rest of the conference.
Thank you so much. Next on our list is Sean from Alerus, going to teach us all about HSAs and why that's such a great part if you're an advisor to get into the HSA world. You're on mute, Sean. I just can't hear you.
There you go. Can you hear me all right?
Yeah, I can hear you now.
Perfect. Hey, everybody, thanks for jumping on today. Ari, thanks for helping out Alerus here, jumping on. Really pleased to be here. My name is Sean Cadle. I am representing Alerus Financial. We have in store here today for the next 45 minutes to the hour. Why
it's a half hour. It's a half hour. Just want to. It's
half
a half
hour. Thank you.
No problem.
I saw both, so I can scrunch, and actually half's better. So yeah, I'm pleased to be here. I'm going to share out my screen and run through a few things. Before I jump in, just a quick introduction about myself. I live in Denver, Colorado. I've been here for over 20 years, and I've been a part of Alerus now for 5 years via an acquisition of an independent TPA here in Denver that was done in 2020. I used to work in retirement space, so I can speak both 401k and also have been in the HSA and the health and welfare space for over 15 years. My prior life, I worked for retail national stores with Best Buy and Home Depot. So happy to be here. Thanks again, Ari. I'm going to share this out, make sure you guys can see it. Go back in here.
Yeah, I can see.
And then I'm
starting your screen.
I'm going to put my presentation on. There we go. You guys see that all right? I got to go to the beginning here. Awesome. All right, so why HSAs matter for retirement advisors. I'm just going to do a quick outline, quick overview about who we are at Alerus. If you want to cover a few basics, really go through the gist of this presentation, which is why these matter to retirement advisors. This is a trend we're seeing, and so if you haven't seen it yet, really tune in. I think there's some excellent opportunities for you all. I do want to take a little bit of time on the consumer mindset that we have. Just a quick bullet on, are we really prepared? We've seen some of these stats I'm going to show, but it shows really how the landscape for HSAs has been set up for really the perfect storm. The paradigm shift that we anticipate and that we're seeing, and really for you guys, the investment trends, and we may have time for a few examples here. Just a quick overview about Alerus, if you haven't heard of us. We are a financial institution. We're traded on the NASDAQ. We're an ESOP, which means we're company owned. Very unlikely that the blue-haired old lady in North Dakota is going to give up their share and their stock to sell out. So we have a formidable and a long-term vision of tripling our size in 10 years. And right now we have over $40 billion in retirement assets. Why am I here? We want to serve our partners, and you guys are a part of that, that story for us. Just a couple things about what you can anticipate from me and my team if you're engaged. We're really looking to equip you guys around HSAs. Obviously, we have the retirement space as well, and we have national wholesalers all across the United States. But we do offer lunch and learn, CE, compliance support, reporting through our systems. We can assist with employee meetings with your teams if you're setting up HSAs. And then we also offer digital resources and marketing to enable you guys to be able to engage your clients. Sometimes the HSA space is a little bit more daunting because sometimes it's being handled oftentimes by a health broker. And so I'm going to give you a couple tools today to help you out with that and also give you confidence as you're building through these opportunities. Our mission here at Alerus is to positively impact financial health and wealth potential. And I put in health and wealth because when we talk about the wealth potential, we're seeing incredible stats in retirement about healthcare expenses. So we have to be aware of that. And so we provide a holistic guidance, unparalleled service, and engaging technology. So just a few basics. You may know this, you may not, but it's really important to know where HSAs fit. The first rule is you have to be enrolled in a high deductible health plan. This is probably one of the reasons why we haven't seen this enter the market as the standard. And I say the market, the retirement space market is what I mean by that. These plans were actually established back in, I think it was 2004 now. We're now over 20 years, and they were really put in place for the purpose of paying for medical health expenses. And there's a couple of misnomers I really want to cover about how these are being underutilized in many fashions and how you guys can help. First off, triple tax savings, you probably hear this all the time. I just want to cover that because in terms of when you're talking with clients, and I used to do 401k enrollments, and we would talk about pre-tax and Roth, which one do you want? Well, how about you get both, right? How about we get FICA savings and we get the pre-tax, we get the investment over time, and then we also get the distribution tax. There's a caveat, you got to use those for health-related expenses, but as you're going to see later, there's a huge demand for that. Participants can set aside HSA contributions to pay for annual medical expenses, and I put "and" in uppercase, or they can invest over time. And this is where I think you guys have an incredible opportunity to take into this space and how we at Alerus are partnering with our RIAs and our retirement advisors to really empower them to win in this space. These plans are portable, much like an IRA. They are offering tremendous impact for these participants, but it could be a huge impact for you all over time, and I'm going to share with you a couple reasons. Before I get there, you guys may have heard of Bill Stewart. He's the author of HSAs, The Perfect Retirement Account. It's a great book. I mean, I talk HSAs a lot, and there's a lot of basic stuff, but he gets into some pretty 501 and some complexities that are pretty interesting. But his quote here, HSAs are tax perfect. There are no deadlines, no immediate substantiation, no RMDs, portable and flexible. So when I look at this and I compare some of the retirement space, and I've worked with a lot of retirement advisors in establishing plans like 401ks and cash balance, and there's a lot of nuance, and these HSAs are much more simple, and they provide a lot better value for these participants over time. Here's probably one of the setbacks of HSAs. They do have some pretty low limits over time, right? So this year they've increased the limits up to $4,300 for a single coverage, and over $8,000 now, $8,550 for the family coverage. I forgot to put in the catch-up here. There is a $1,000 catch-up that you can put in. If you're married, it's a single spousal catch-up of $1,000, so you can't put in $2,000, it's just $1,000. There has been proposed legislature to increase these rates significantly, making them look much like a 401k. I believe in 2022 or 2023, this got pretty far down in the legislature as far as where it's gone. It didn't get all the way yet, but they had proposed limits at single coverage at, I think it was $7,500, and the family at like $15,000. So there could be some movement down the road that would really activate some opportunity, make these look like a 401k in terms of their money. I looked it up this week. Our system has the largest account holder, and our system has $365,000 in their HSA. So there's some legit reasons to get in this space. There are different variations in how we can compensate. There are also some limitations, and if you're interested in some of that, I'm happy to help. I will have my contact information here at the end of the presentation. So HSA 101, we talked about you have to be in a high deductible health plan. You can pair that with a health savings account. And health savings accounts can either be supported via a payroll deduction from the employee, and many of our clients are offering some type of a fee deposit. It could be like a non-elective is what we would call it in the 401k industry, or they could do a match. There's a lot of creative ways to really empower the employee to really boost up their engagement in these accounts. One of the biggest misnomers with these is, you got that first box there, near-term expenses. This is what people are using these for primarily, and that's been the problem. But there is now becoming more awareness, and we're seeing a lot of data supporting people that are investing, which is long-term expenses. Just to put it in perspective, and I'll show you an example, but you can go and you can have a medical expense for, say, $1,000 today. Actually, use my daughter as an example. She got braces. Last year, her orthodontist bill was almost $5,000. And that HSA contribution for me, I paid out of pocket. And at the end of the day, I can leave that money in my HSA, and I can wait till I'm 65 years old, or at any time I can take the distribution. I plan to wait until I'm in retirement. And at that time, that money is going to grow, and I can then take my expense. I can take a distribution on that $5,000 roughly, and there is no tax that's paid on it. So I'm using that money to invest rather than just paying it and expensing it here as a reimbursement immediately. It's a great tool. The purpose of HSAs, again, is to help people actually afford healthcare now and in the future. We look at healthcare now, and that's really the focus. And there's a lot of increased, deductibles, and there's a lot of increased medical expenses that have happened. But if people can get ahead of that and they can look into the future, there's some tremendous power in that. Some stats here that are a little bit daunting. I always like to look at where we are. 25% of employees do not contribute to their HSA. This is for plans where they're eligible to participate, and they're just not taking advantage. 33% of those enrolled don't even open up their HSA. So now we not only have people opening an account and not contributing, we have a lot more people not even opening an account for that matter. 70% of HSA investors are poorly diversified. You've seen this in the retirement space, right? They're in some target date fund and maybe other funds. Maybe they're all in some high risk and they don't need it. Maybe they're all in cash, and that's not a good place to be. 40% have reached their minimum balance threshold but not invested. We're seeing a trend here of this going up. I think this is an excellent opportunity where people are understanding the compounding methodology. If you've read Darren Hardy's book, The Compound Method or The Compound Effect, tremendous value in that. So we're going to provide some solutions. So why does this matter for retirement advisors? So I just have 6 reasons here, but I think there's a number of others. To keep it really straight to the point, retirement service didn't matter. Now they do, right? I think when I entered the industry in retirement, there were retirement specialists and there were a bunch of people who really didn't even want to think or talk about retirement. They didn't know anything. And now I'm seeing more and more investment advisors really expand their landscape into retirement services under 401ks and cash balance and defined benefit. I think the primary reason is there's an opportunity to make money and to serve their clients and protect. So we have a lot of similar things here, but I'll steal this from one of my sales consultants, Larry Meiselman. He says, hey, if you had a time machine, would you go back to retirement services and 401ks when they weren't really a big deal? And the answer for most of you, I think, is yes. And here we have the same opportunity. HSAs today are really not making a lot of headway, but we know there's going to be a paradigm shift. And so if you get in early, you can find yourself into a situation where I think you can capitalize through these movements that we're seeing. The second reason I have here is you want to protect your client, right? You want to save your clients. Your competitors may be coming in and offering an HSA solution. Big Green is out there. They're marketing direct on these HSAs and their 401ks. And if they get in and win one, they may get the other. So be aware of that. This will give you an opportunity to add value and differentiate yourself in the marketplace today. I like to pair that with number 6. It's really easy. So when you add and differentiate, it doesn't take a whole lot, honestly. You are already qualified to serve in this arena. Today, these plans mostly exist under the influence of a health broker. And what they're doing is they're saying, you have a high deductible health plan and you're eligible. Let's go and see if this is a good fit for you. They don't have a Series 6, a Series 7, a 63. They don't have the qualifications to serve for that and in your future portion that I spoke about earlier. They only have the equipped, tools to be able to serve for the here and now. And the sad truth is we've replaced a service called the FSA Flexible Spending Account with what we call a health savings account. And most people are using the HSA as if it's an FSA, and that's not why these things were created or how they were created exactly. So there's a tremendous opportunity for you, and you already have the power and really the knowledge to help. The last thing is save your clients money. I'm going to show a few examples here. I think money is always the goal in terms of either compensation or saving and time and making it really easy around these solutions. Just a couple of comparisons when we look at these plans. The health savings account, when you look at the triple tax savings, I mentioned this, you get pre-tax, you get Roth. The caveat is you got to use it for health expenses, but let's say you don't. Let's say you're healthy and you retire and you're like, hey, I want to buy a boat. Well, then it operates like a traditional 401k plan at that point. So at that point, I would say there is no loss, so why not? Tax-free savings, tax-free growth, tax-free distributions. That's the triple tax. Both of these offer investments. Obviously, there are some restrictions and some of the investments that you get in health savings accounts. I think things like bonds and there's some other prohibited types of investments. But there are no required minimum distributions, and I know that that's a pain in a lot of people's tail. And so health savings accounts provides more flexibility in terms of what they do there. There's no income limitations. There are no income limitations with 401k. I realize that, but you guys are probably working in individual wealth space, and the Roth IRA is oftentimes a vehicle that is pursued. And if you're over the cap, you're like, hey, that's not an option, and the HSA is. So I just want to make sure you know that. I just want to show this as maybe a top to bottom. These are the retirement options you have. I'm not going to go through all of them, but you can store money under your mattress. That's kind of the bottom of the barrel. You can go up into the 401k space. We talked about that. You're actually investing over time. You are taxed. There's some flexibility in terms of early retirement. That's great. The HSA space, it's the top. I mean, this is the hierarchy. The HSA.
Sean, I don't want to interrupt, but Sean, somebody had mentioned a Q&A to increase the size of your screen so it takes the full screen because they're having a tough time reading it.
Is that true for you too, Ari? I have it on the whole screen.
Yeah, but I see the slides and it's still not taking up the entire screen.
I see what you're saying.
Yeah.
Yeah, let me do this then. I think I know what you're saying. I have my other one shown. So I'm going to try this. Does that, nope. Hang on. Sorry, I thought I was on my other one here. Let me pull this up. You know what? Let me do this. Let me do this. I got a better idea. Okay, hang on. One more quick share and I'll have it here.
While you do this, someone had a question. Is HSA preferred over 401k? Or do they go hand in hand? I kind of know the answer to that, but what do you say? Oh, now
Did you say it?
is HSA
Repeat
preferred
that,
over
please.
401k, or do they go hand in hand?
Yeah, they can go hand in hand, right? These
Right.
could be mutually exclusive products. But at the end of the day, I would say, 401k is a great opportunity, and HSA is another great opportunity. If you're today, and this is I can't go into all the detail here, but I will tell you this: today's mentality on the HSA and the 401k pair is, okay, go into your 401k, max out your match, and then maybe even max out your 401k. And if you got some money, put it in your HSA. I'll tell you my personal opinion today, and I'll tell you what I think is going to happen down the road. Today, yeah, don't give up free money. Go in your 401k, get the match. And then once you get the match, max out your HSA. And then once you max out your HSA, go max out your 401k. That's what I would tell you to do. We are now operating with, and I have meetings with some ERISA attorneys considering this. HSAs are technically not handled by ERISA. They're not covered.
Correct.
So they're a different breed. And there's plan document requirements with 401k, but if you go look up Bill Mon, who worked for Mercer, and I don't know where he's at now, he wrote an excellent article about the power of the HSA and incorporating a matching technique that corporations really should be pursuing, where they're incentivizing employees as much or more in the HSA than they are in the 401k. I'll leave it at that. If you guys want more information about that, I'll have my contact information. I can send you some information, and I'm currently writing a white paper regarding this mentality. Our team is working on a product solution on this, which I hope will go through, but we're pretty early yet. Make sense?
Yep.
Okay. Yeah, so boom or bust. I mean, we have a big opportunity here. 46.4 billion estimated in HSA assets is 2023. I hadn't seen the new Devenir reports on this, but this continues to skyrocket. In fact, just for time, I'm going to jump through that and I'll show you some scope about what's happening. Anybody watch SNL, Debbie Downer? I'm just going to turn into her for a little bit here. 36% of U.S. adults say their finances control their lives. I'm sure you guys work with clients, and that's the case. I think anecdotally, it's just easy to see. 33% of U.S. adults say that giving a gift would put a strain on their finances. A couple more here. 1 in 4 adults could handle a major or unexpected expense. That means 3 can't. Okay, so that's what we're talking about. 28% say they're doing very well. These stats are from Morning Consult rather, but you've seen them in the Fidelity stats that they provide. There's a bunch out there that you've seen. I'll skip over this. Here's another Debbie Downer, and you guys have seen this stat over and over again in the retirement industry. The estimated expenses in retirement for healthcare, guess what? Over $300,000 currently. That's for a married couple once they hit retirement. The potential future liability is upwards of almost 1.4 million. I'll just get quick about why that is. Most of it's due to long-term medical, medical costs, staying in a medical long-term care. That's what I'm looking for. So most of that is due to that. So there's opportunity here in terms of saving in retirement. If you're planning on being healthy, good luck. Because we know that statistically, the odds are you're going to be spending a lot of money on healthcare. So it's really important that your clients are saving money to prepare for this transition over time. The paradigm shift itself, HSAs have just been misunderstood. Most people are treating them as if they're an FSA. They're putting money in, and they're only putting enough money in to cover the year, and then they're exhausting their account. This is what about over 50% of the accounts are doing. And there's changing, thankfully. There's more and more people who are saving and putting in enough to cover deductibles and things like that. But because they're tied to the high deductible plan, they have been promoted by health brokers. And this is where I'm encouraging you guys to dialogue at the very least, and maybe even jump in the space to help clients understand the future of the investing. A couple of things that I think is interesting, the lack of marketing around these is intriguing. First of all, the health savings account was the nomenclature is just an alternative to the flexible spending account. It's very similar. I would have preferred them to call this a health investment account of some sort to help people understand that it's really built for the purpose of retirement, but it can also be used for near-term expenses rather than used for near-term expenses and might be used for long-term expenses in retirement. The other thing I bring up all the time, they called it a high deductible health plan. I think that's ridiculous. If you guys are enrolled in a high deductible health plan, I actually call it a low premium plan. People are saving a tremendous amount of money on these low premium plans, high deductible plans, same thing, because they're not paying as high of a premium. They're saving money out of their pocket immediately, and those dollars can be used to subsidize the HSA. So I think there's two things we're looking at here. The first is the lack of incentive for the health broker because they oftentimes are incentivized by the cost of the premium. The higher the premium, the more commission they make. The other thing is for you guys to grab that space, there's a lack of incentive for you all as well because traditionally these balances have not been very high, but now we're finding after 20 years, people are starting to get it. And so these balances are going to start, there's going to be a trend, a paradigm shift where more and more people are going to invest, more and more people are going to have assets that are going to matter. And if you guys are managing that space, you can capitalize financially on it. The last is the health brokers aren't equipped to handle, in my opinion, some of the most important elements. And when I talk with the health brokers, by the way, they're partners of mine, oftentimes peers and friends. They are not bashful to say, listen, I would not be heartbroken to lose this HSA responsibility. Like somebody take it. They don't get paid on it usually. There are a few that maybe put in a comp structure around it on a per head fee. That's very rare. They're oftentimes using this to supplement the health plan that they're actually selling, and they're not being compensated on the HSA. So in terms of the competitive landscape, this is sitting with someone who's not incentivized to actually sell it, and they're not equipped to talk about investments. They don't have a Series 6, 7, 63. They don't have any of that. So this is a great opportunity for you all to jump in and provide some support. Ari, any questions out there?
Quite a few.
Okay.
Are there why are there contribution limits for 401ks and HSAs?
Yeah, most of it has to deal with the IRS limiting their liability in terms of their tax benefits. I'll leave it at that. I mean, that's what they're doing. They're balancing the opportunity of participants to have tax deductions, but if they over accelerate that, they are losing out on tremendous revenue. The IRS, Internal Revenue Service, they're missing out on that. So they have to provide a balance for that.
Okay. Are you saying that in the near term, you can pay the medical bill and years later, take the monies out of your HSA account to reimburse yourself for the prior year's medical expense, likely with the growth of those funds if invested wisely?
Yes. Thank you. Here's a great example of that. You have a medical expense of $300 today. If you paid it out of your bank, you're losing $300. And this is the mindset of a health savings account. But if it's a health investment account, you're investing that $300. So that $300, 6% interest rate over 30 years, that's $1,800. And yes, you can have the expense today out of pocket. You can wait to 30 years or however long you want. It could be next year, and you could use it as an emergency savings account. Or you could wait till you're retired and maximize the investment over that time, and then you can take the distribution for the $300 that you had 30 years ago.
Got it. And here, can you speak to using the HSA in retirement? What I'm personally doing is using other income for out-of-pocket medical and allowing the HSA to grow at maximum rate. Turned 65 recently, so can't contribute anymore. I wanted to double or quadruple before gradually touching. He said it's an awesome tool.
Yeah, I don't know what the question is there.
Yeah, I
think
know.
you're
More of
doing
a
it right.
statement. Yeah. Here's the
Yeah,
number.
I would just say, yeah, keep investing over time. You can manage those like you can a 401k. You can change investments into a more protective type of investment balance if you want an allocation.
Okay, here's the last one. A regular health care plan for a family costs about 200 a month. If not used or if not used or use the money you pay is going to only pay for the plan per month. So after a year, you spent so much money. Are you saying that if we offer our employees an HSA plan, the money they contribute and don't use rolls over every year, and whatever is not used by the time they try, they can withdraw it? Can they also withdraw at any time? How is it ensured that the money
Yep.
follows the employee should they terminate from an employer?
Yeah, a lot there. So I'll just cover what I think is being asked. A couple things. One is, yes, you can make contributions at anytime you want. Unlike an FSA where you elect and you're stuck, with an HSA, you can fluctuate much like you can with a retirement account. That is a portable account. It's an individually owned account, much like an IRA. It moves with you anywhere you go. There is no requirement to take a distribution at any time. And so you can let that money grow as time goes on.
Perfect. And that's it for the questions. Someone else had a general question. We are going till 3 today Eastern. Tomorrow we start up it again at 11. All new topics, all different materials. And that's it for the questions.
Yeah, and I think we're at time, right, Ari?
Yep.
I have my contact information here.
Yep.
If you guys want to reach out and you have questions, we do offer the best suite out there in terms of pricing and services, but for time's sake, I'm just going to leave it at that. And thanks, Ari, for having us on. Really appreciate it.
Not a problem. It's always great to hear Alaris on HSAs. To me, it's just something that, another tool for the advisor's toolbox. Speaking about healthcare, James Holland is next with topic at hand, healthcare and 401k, two worlds colliding.
All right, hang on a second, Ari. Share my screen here. All right, where's the button, Ari? Here we go. Hang on a
Yeah,
second.
there you go.
There we
Share
go.
screen.
Share. Right. That should be it. And let's get that in. Oh, let's go back here. All right, are we in can you see it, Ari?
I can't. I just see you.
You just see me. All right, hang on a second. Let's try this again. More. Share my screen. It says go here. And all right, how about now?
Now I see it.
All right, perfect. Here we go. Put that in. Appreciate the time again. Always good to catch up with everybody. For those who aren't familiar, Millennium is an RIA that specializes in retirement plans. 99% of our business come from outside advisors. And I've gotten ahead of myself, so let me get back here. I got to try that one more time. We focus on retirement plans. Over the last couple of years, we've seen some opportunities with regards to, we made mention early for those who joined us earlier on, how the healthcare world is starting to move into that realm as well. So one of the things that we spent the better part of the last 2 years working with some folks who specialize in that area. Bill made mention of it a little bit, the fiduciary responsibilities for the plan sponsors, especially the larger employers and those who are offering some type of level funded or self-insured programs. Have a fiduciary responsibility to the participants, just like they do on the 401k side. We always, whenever we get an opportunity to get a Seinfeld reference in, we always like to do that on Ari's opportunity, on Ari's podcast and other events. So again, for those who used to watch the show, you can see the worlds colliding. Why is it important for advisors? It's basically going to be two options. I think the last gentleman hinted at a little bit as well. There are two choices because this is going to come dramatically faster than any changes with regards to the 401k plan took place. So you can view it as an opportunity or a way to find yourself out of the business. Healthcare is by far the largest concern, not just for employers, but for employees, not just from a health standpoint, but also from a financial standpoint. You can't go a day, unfortunately, without hearing a story about someone being worried about not getting healthcare because they can't afford it, or going bankrupt because of medical bills. Litigation has picked up a little bit in that space, only been a couple of cases, but that will pick up dramatically. Why is it important for the retirement plan advisor? Because again, the competition is growing, and you want to make sure that you're able to offer all of the opportunities, not just, again, you don't have to be the expert per se, but if you are not at least having the conversation and offering some ideas and resources for your clients, they will find people who can do it. The big boys, so to speak, and if there are any on here, I mean no offense whatsoever, but the larger firms used to play only in the large sandboxes. Those days are long gone. They are now coming down market and working with plans of any size. And again, as this is one of the largest expenditures for the employer, so if you can find a way to help them control that while offering a better benefit for their participants, and doesn't necessarily mean you, but the folks that you work with, it's going to have a tremendous impact. Pardon the bluntness here, but I'm a big Captain Phil fan, for those who like watch the show. Basically, again, you're going to sit around and say, okay, how does this impact me? What is it going to do? Because there's no stopping this evolution. Okay, the cost, we talked about it from a 401k perspective, how the consolidation took place in record keeping, it's taking place in asset management. R&I, for the better part of 16 years, talked about the changes with regards to revenue sharing and those impacts and how it changes here. We're talking millions, tens of millions, hundreds of millions of dollars in some cases for employers. So helping out from a 401k perspective, there's money to be saved from an administrative standpoint, but there's a limit to that in terms of what can possibly be saved. Again, from an investment standpoint, there's opportunities. On the healthcare side, it's overwhelming, the dollars, and the difference being is this is real dollars that go towards the bottom line. I know people think about cost sharing and cost savings from a retirement plan standpoint. There are only a few different areas where that can take place. Here, there are a number, and we're talking significant dollars that get given back to the employer that can help fund things like an HSA, like an emergency saving account, like enhanced matches. So by giving them the opportunity to retain some of that money that's being wasted within the system, gives them an opportunity to enhance other benefits as well. I mentioned this just a couple minutes ago, circling the wagons. You need to protect yourself, especially for the smaller independent advisors out there who are constantly getting pressured from other bigger firms who purport to be able to offer different services. Here's a great way to help protect yourself, but also protect the client. Because again, I think Sean just mentioned it. If they come for one thing, trust me, they're going to come for everything. Nobody's walking in saying, hey, can I help you with just this piece? Why? Because they're trying to obviously increase their profitability. And if they have more lines of business with one client, it's much easier to do that than to try to walk, and find a bunch of new clients. So this is a great way to help protect yourself, and also obviously find some other professionals who might be able to reciprocate, who don't specialize in the areas that you do. That's one of the big things we do here. So I mentioned earlier, we're a registered investment advisory firm. We don't do any education. We don't do any investment advisory work. We leave that all for the partners that we work with. So while we're all licensed and we can do that, it's not a service we provide, because we leave that for the partners that we work with. So therefore, again, it helps enhance that partnership. I've said this on every podcast and every event I've ever done with Ari. ERISA is now and always will be a team sport. The folks who want to go it alone, you're going to find yourself out of this business at a much faster pace than you would have 5, even 10 years ago. It's just too complex between regulations and litigation and all the changes, and now this confluence of the benefits coming together. You need to be able to have a team of professionals that you can turn to who can provide some level of service or professionalism that you can't. There are just too many things and too many complex things to know everything, to be that person who said, you can be the contact person and you can be the quarterback, but you need to make sure that you have the right team of professionals available to respond. And as we talked about earlier, especially with all the technology coming into all aspects of the ERISA space, you want to make sure that you have the capabilities and the access to the very best, because people do not wait around for answers anymore. They are not necessarily a quick fix, but obviously they do expect a certain timeliness to obviously any answers or help that can be provided. Staying in your lane, that's one of the things, again, I just hinted to there. Yeah, the jack of all trades and the master of none. You want to make sure that when the client is viewing you as the professional for whatever it is you focus on, whether it is participant outcomes or education or succession planning or life insurance or financial, whatever that is, stay there and focus, but let them know that you have the capabilities and the people to turn around to help them with other aspects of it, because they're going to value that much more if you take the time to say, hey, listen, I know this is not my area of expertise, but we see it all the time. And we do just want to let you know, we do have the capabilities and the resources and the people to go to, if these are problems that you're facing at the moment. Because especially with prospects, because it might not be the retirement plan right now that is the issue, okay? It might be the health insurance. It might be, something that HSA or whatever the case may be. You want to make sure that you're able to turn around and reach out to someone who can provide that connection. So therefore that even if it's a prospect, they can turn around and say, okay, wait, oh, that's the person who helped connect me with someone who can fix my initial problem, because then it's easier to have the conversations about, the areas that you want to work in. Long-term greedy leads to longevity. Sadly, in our business, and I said this, a dozen times or more, instant gratification, looking for that big payday right away because you're afraid you're going to get pushed out or fired. That's people pick up on that. This is not, this business is not full of great actors. Okay. So if someone sees a money grab, it's automatically going to impact the relationship from a long-term standpoint. So take the time, build the relationships, help them with every area you possibly can, because that's how you're going to hold on to the client, because there's going to be less opportunity for someone to come in, but also you're giving them less of a reason to look elsewhere. Yes, clients should obviously, on a fairly routine basis, do an examination of all of the service providers, okay? But when you're consistent and professional and providing the guidance and doing it as a reasonable fee, then that the holding on to the client, I think that most studies show it's 4 or 5 times more expensive to get a new one than obviously maintain it. If you're taking care of it and doing the right thing, obviously, while you want to stay engaged and involved, the work itself becomes less, so the profitability automatically increases with regards to those clients. So that's why you want to take the time to make sure that you're looking at it from a relationship standpoint, not a trying to grab a piece of business standpoint. Again, I know I walked through that relatively quickly. As far as information goes, Ari, I just wanted to give everyone a quick, 30,000-foot view, if you will, of where the space is headed. The litigation aspect is going to be very important. Again, I know it's not something that most people will think of right now, but rest assured, it is going to become a huge topic, and it is going to move significantly faster than it did on the 401k side. And as I made mention at the beginning with Mike and Bill and Ari, we're talking tens of millions and hundreds of millions of dollars of liability for employers. But not to play the doomsday card, but the actual dollars, just to give you some perspective on a few of the cases that we've been able to work together with some advisors. We had just done a 250 life employer group, helped them make some tweaks with regards to both the retirement plan, but also on the healthcare side, and returned $900,000 to the employer in actual money. And I'm telling you, that resonates with people because that goes right back to the bottom line. And as the groups get bigger, the dollars get bigger. And again, there's ways of working, and because now you can turn around and talk about changing the match or offering some other type of benefit that if you're looking at it from for the folks who are dual licensed and maybe get involved on the group side. There's just a host of ways of changing, but that when it comes to real money, bottom line stuff, that's obviously what moves the needle for most employers. But it also, again, it enhances the benefits so that people are now using them. Okay, so they're not getting sick or coming to work sick or avoiding work because they are sick. So they're getting quality benefits without having the fear of going bankrupt or having to overpay. The Synchronomics is the firm that we put together, which is what we use to work with for advisors with regards to this new approach. So you can go to synchronomics.com or obviously reach out to me at any time if someone has any interest or any other questions. But the confluence, again, of all of these benefits coming together, Human Resources is looking for assistance on all of these because, again, it's become those departments are shrinking, the responsibilities are growing, people are trying to find ways to economize all of these things. Again, they don't want to take away the benefits per se, but if it becomes a dollar issue in terms of maintaining the company or maintaining the benefit, then clearly, obviously, they're looking for how they're going to keep their head above water by making some, changes to the retirement plan could have a very positive impact, not just on the bottom line, but to the benefits that are being offered as well. So I don't know if there's any questions, comments, Ari, feel free to.
Yeah, I mean, so you talked about, 15, 16 years ago when we first talked. I mean, it's going to be 15 years since I started my practice. What, if you go back to 15 years ago and, it's kind of like with like medicine. Remember back in this, you're around my age, kids, they said, know your blood pressure in the 70s. That was like the big thing. And then in the 80s, it was like, know your cholesterol. So what do plan sponsors got to know about their, healthcare plans right at the get-go that they don't realize? Because,
there's a whole bunch of different aspects because most of them, especially the small employers, know very little because the insurance companies don't have to tell them, and they don't. So some of the changes, and again, it's not, people get too caught up on the data and how do I get my lost, how do I get that information? We're talking about basic stuff, direct primary care. So instead of literally having a network where people can go for anything preventively with no copay, no co-insurance, and no deductible. So they can get basic health care so that therefore that doesn't turn into some other dramatic sickness. Knowing for the folks who do have significant issues, whether it's some type of, God forbid, cancer, or hemophilia, premature birth, that type of thing, how to control that. Not just from a care perspective, which obviously is first and foremost, but from a cost perspective. And there's a whole bunch of different ways. Pharmacies are a big issue. Again, there's a lot of waste, fraud, and abuse going on within that in terms of the middlemen and how the formularies are put together and what the cost of the drugs are and how to go about getting them. For those who have been paying attention, Mark Cuban has started basically a PBM that has changed the cost structure for a lot of people. So we're not trying to take away from the benefit. We're just trying to have more control, because then what that will also do, and we talked about AI a bit, but there are some very promising technologies within the AI spectrum, which are putting together that information that it could potentially help predict health outcomes on an employee by an employee basis. Who's more susceptible to what? How do we preempt that? So there's a whole bunch of really fascinating things going on. And it's, like I said, the evolution in the 401k space we've watched over the last decade, this is going to go much faster, only because the dollars are so significant. And now people, whether it's for the litigation or the horrible incident with the United Healthcare CEO in New York that has now brought it to the forefront, people are getting upset because, again, the costs keep on rising and the benefits do not in a commensurate fashion. So they want to make sure that, they have access to that for themselves and their family. And there are a lot of great ways to provide those services without having to, make it a drain on the employer or the employee from a cost standpoint, which then ties right into the retirement aspect, because they have more money to save, they're healthier, they're going to live longer. And then there's ways to, help from a planning perspective there as well.
Okay, I think that's it.
All right, great. No, as always, appreciate the time. And like I said, if anyone wants to reach out, by all means, again, you can hit the website or reach out to Ari. He'd be happy to provide some the contact information.
Yeah, well, JamesH@miracenter.com.
Perfect.
Okay.
Appreciate it, Ari, as always. Thanks, man.
Not a problem. How about the Mets this year?
Yes, we just gotta get this
Reset
Alonso saga one way or the other. Either sign him or replace it, but it's just dragging on too long. That's all.
Yeah, I was talking to Carlos Mendoza a couple weeks ago. He was at a signing, so he didn't have a good line. He didn't have a long line. I'm like, can't you guys just? He's like, I don't know anything. If he knew anything, it's not like he was going to tell me. But
Tell you anyway. But yes,
yeah.
But good enough. Only about 40 days away from opening day, right? So
yeah, it's a couple weeks before spring training, so
you got it.
It'll be great. So I don't have to think about the Rangers.
Exactly.
Yeah. Okay, so everybody go to that401ksite.com to sign up for our live events. We will be live at Kauffman Stadium in Kansas City, Missouri on May the 9th. Anaheim, which is the Angel Stadium, with these stadiums, they're changing their names every 5 minutes. I mean, Minute Maid Park's no longer Minute Maid Park anymore. But we'll be there, I think, on Thursday. I want to say it's June the 5th. We'll also be September at, I think it's American Family Fields. I think that in my mind, it will always be Miller Park in Milwaukee. We do this, but we do it live. There's food. We have a entertaining guest, former great for the team that we're, at. We'll try to have game tickets. I already have the game tickets for the Kansas City Royals. I think they're playing the Boston Red Sox that day. So go to that401ksite.com. It's $100 to attend. It's 5 hours worth. A lot of fun, a lot of entertainment. If you have multiple attendees from the same firm, we charge $50 a head, try to get as many people as we can to these events. Go to that401ksite.com. We will be back tomorrow at 11 a.m. Eastern. If you check the emails from me, you'll have the agenda attached for tomorrow. And we could start a couple of minutes early, I guess. Let's see. I'm looking at day 2, which doesn't help me. Greg, you there?
I'm here. Can you hear me?
Yeah. I don't see you, but I can hear you.
Yeah, I don't know why my camera's not working, but I'm going to share my screen anyway, if that's okay.
Yep.
Can you see that?
Yep.
Excellent. So are we ready?
Yep. You can go.
All right. Well, thanks, Ari, for inviting me to participate today. And I want to thank everybody for joining us. My name is Greg Reed. I'm Vice President of Sales for Q3 Asset Management. We're a registered investment advisor, and we provide managed models, including retirement plan models. We've been doing retirement plan models for a number of years. I think since 2016 is when our models came out. We're not going to talk a whole lot about those today. We're going to talk about, I like to share stories, and I really like success stories. I work with an advisor. We're going to talk about him in a minute, but I work with a lot of advisors that are really successful, but I work with one who seems fairly extraordinary. I was having lunch with him last year and last fall, and he was regaling me, and we were recounting how his business has grown precipitously. As you can see, he went from 0 to over 400 million in 4 years. It's actually just under 4 years. And his story is pretty unique. So I thought I would introduce you virtually to Nick. I'll tell you a little bit about him, how he's grown his business, and how advisors that you are working with, or you yourself, can maybe employ some of his techniques. Many of these things are going to come as common sense, things that everybody knows, but just the way Nick has employed them might just be a reminder that there's a lot of business out there, and it's easy to capture if you know what you're doing. So let me go to the next screen. So I want you to meet Nick. This is Nick. He had a cup of coffee in the NBA back in the 70s. He loves golf. He's obsessed with golf. Would golf every day given the chance, but we're here in Michigan, so it doesn't always work out. He was in the corporate world for 15 years. He actually was in business development for a large CPA firm. He was not himself a CPA, but he's such a great networker. He was given the opportunity to do business development for this CPA firm. He worked as a travel agent, and now he's an advisor. So he came to our industry kind of late in life. While working for a CPA firm is somewhat related, he didn't do anything in the retirement plan space at all until recently. I met Nick maybe 6 years ago, and we were at an event together, and we started talking about what we do and what he does. And he was really a rainmaker for a small RIA. He had left his corporate job working for a CPA firm, and he was looking for something, and he stumbled on the idea of working for an RIA, and they said, well, you can become a business development person here. But in their mind, the business development role was different than what any of the rest of us probably would have thought of. They got Nick licensed, and then they just had him introduce any of his leads to them. So Nick didn't really act as an advisor despite being licensed. He would bring people in, and then the RIA would service them. So they were not his clients. He was not paid for those clients in the way any of us would think you would be paid for those clients. He more or less went golfing and networking and brought people to the table. And one day he and I were at lunch, and he asked me, well, how do RIAs get paid? And I said, well, there's a range of ways people can get paid in our business. I said, depending on where you work, if you're with a wirehouse, you're going to get paid a smaller amount, but you're going to have more oversight and more support. And if you can be completely independent, you can get 100% of the fee. And he realized he was being significantly underpaid for the business he'd brought in. And so he left that RIA, and he called me and he said, I'd like to do this on my own. He's not really on his own. We helped him find a home, but he's really a lone wolf. He works for a regional RIA firm, and he is just 65 licensed and just goes out and calls on retirement plans almost exclusively. So as I said, Nick went from 0 to 400 million in just under 4 years. And this is kind of a snapshot of the plans that he has. And you will notice they range from essentially startup plans all the way up to a 90 some million dollar plan there. And what I think is really interesting, and I think I should point out, you'll notice that he has no allegiance to any single custodian record keeper relationship. He pretty much works with just about anybody. He's totally open to working with anybody. So if you are a record keeper and you'd like me to introduce you to Nick, you can reach out to me and I will arrange an introduction to Nick. But here's the secret. Nick doesn't recommend any providers either. Nick's secret to his success is he takes over the plan where it is. Now, eventually he may move the plan, but initially his secret is not to try and sell them a new record keeper or sell them a new provider. He just convinces them that Nick is a better advisor to their plan than they currently have. Matter of fact, Nick called me this morning. He had a meeting with a new plan. Someone referred to him, and it was a $56 million plan. And the plan sponsor said, "So how many plans like ours do you have?" And Nick's answer was, "I don't have any plans like yours because every plan is different." He said, "I have plans that range up to $90 million and from startup, but every plan is different." And then they asked him, "Well, Nick, if you were in charge of our plan today, what would you do differently?" And Nick said, "I would fire myself because your plan needs help." And he said he got a laugh out of the room, and now he's getting their fee disclosure, and he and I are going to sit down and go through a review of that plan. But the point is, Nick is a charming guy who's only been in our business a very short time, but he has demonstrated a great deal of success by working with the current plan provider and just going in and convincing them that he's a better solution as a rep than whoever they're currently working with. So what Nick sees 4 keys to his success. His first is he always likes to create doubt. He realizes that the vast majority of plan sponsors don't really understand our business anyway. While they may be fiduciaries to their plan, they don't really understand what that means. They don't understand their liability. They certainly don't understand the investment world and all the different options that are available. They make widgets. And if they're widget makers, how can they know as much as the people on this call? So he creates doubt with that they don't know enough. And he does that through a series of questions that essentially make them think they should know more or need some help. Then he establishes authority, partly by asking the right questions, and then partly by coming back with a great deal of information about their plan. He and I run Larkspur reports. We do FI 360 analysis. I do fee benchmarking for him. And then he brings all that back to the table and he says, "Here's what I have found." And he acts as though he is the consultant already to the plan. Next, he believes in fixing the plan where it is, because that's the low-hanging fruit. So what he'll say is, "I looked at your plan and it is suboptimal." He believes every plan is suboptimal. "Your plan is suboptimal, but I want to help you make it optimal." So then he'll say, "But don't worry, we can fix it where it is." And he says that's a powerful statement. By saying we can do this without you having to change it. You don't have to move anywhere else. Now, I realize we have a variety of record keepers on this call that would say, but they would be better to move it from wherever they are to me. And that may be true. But for Nick, he wants to get in the door. He said the secret is getting in there, becoming the rep of record, servicing the plan. And then once he's developed a relationship with them where they trust him implicitly, he can then say, "You know what, we've been working with XYZ for the last year, and I just don't think that's the best fit for you. I'd like to bring some other solutions to the table." If at that point they say, "Great, bring something, let's see what you have to say," then he'll move the plan. If they say, "You know what, Nick, we really like XYZ, and we don't see a reason to change," then Nick still has the plan. There's no penalty to him. And then finally, he asks every one of his current plans for referrals at every meeting. I realize we all know we're supposed to be asking for referrals, We've all been to all the seminars where they talk about referrals. We've all probably taken training where they teach us how to get referrals. Nick is really good at it. I've sat with him and he shows them how great they're doing. He talks about all the services he provides every quarter. And then he said, who else should know about this? And he asks for referrals from everybody. There are times where I'm surprised some of the referrals he gets. He got a referral from the Fidelity wholesaler. And Fidelity usually does that stuff in-house, I thought, but he asked him for a referral and they gave him one. So he does things a little differently. Maybe he's doing things the way that we all should. He and I put together a conversation guide. One day we sat at lunch and we both knew the questions to ask. I think everybody here knows the kind of questions you'd want to ask a plan sponsor to create that doubt and to demonstrate some expertise. But he and I just started jotting them down, and it ended up being 4 pages. And so we created this summary of questions to ask a plan sponsor, and you would never ask every single one of these questions. And many of the questions in this guide you could get on your own. We could get from a 5500, but a lot of the questions are meant to create that doubt. So it'll ask, how often does your investment committee meet? Who makes up your investment committee? When was the last time your investment policy statement was reviewed? And we all know most plan sponsors wouldn't know how to answer those questions, or if they can answer 1 or 2, they're still going to be unsure whether they're doing it right. So if any of you would like a copy of this conversation guide that we put together, I'm happy to send it to you. Just email me. My email's on the screen. It's greed@q3tactical.com. I'd be happy to send you a copy of this. But we put this together as a way to kind of formalize the process of meeting with a plan. So what often Nick will do is he'll reach out to me and say, I'm meeting with Pace Industries, and can you pull up their Larkspur report and send it to me before I go? And I will not only pull up the Larkspur report, but I'll fill in some of the information on one of these conversation guides. I'll send that along with Larkspur. So then he's got that information to start with. And then when he goes through, he'll collect whatever information he thinks is important. He'll send me back the conversation guide with the fee disclosure and a plan document if he's gotten that. And we will do fee analysis and we'll do an FI 360 report. And then we'll take the points that were identified in his questions of things that they were concerned about, issues they had, and give him those talking points to try and win that plan. So we realize, and everybody here realizes, there are a lot of existing opportunities out there. Nick says, as I mentioned before, that every plan is suboptimal. Sometimes he will point out suboptimal things that really aren't a big deal. If you take a look, on Larkspur, you'll see that there are almost 200,000 plans out there that don't have a QDIA. Nick explains why it's so important that they have a QDIA. Now, certainly there are plans out there that may be so small that the QDIA is not an issue for them, or they don't have automatic enrollment. He makes it sound like that is a significant issue. These are all important things, but he makes them sound like they are the biggest thing. An insufficient fidelity bond, or they paid corrective distributions, they have participant loans. I would argue that none of these things really are catastrophic for a plan. They're all easily remedied, but Nick likes to point them out and mention that these are things that they should have fixed. In addition to that, he likes to emphasize that a plan sponsor has this duty, this ongoing fiduciary responsibility, and he emphasizes that if they're not aware of that, then they should outsource some of those services. So he'll recommend RE, or he'll recommend 338, and he'll emphasize to the plan sponsor how important those things are. So every one of these things are just points that everybody on this call would understand to make, but Nick does it every single time. He also points out that litigation is a big fear of plan sponsors, and he asks them, are you concerned about litigation in your plan? And if they're not, he makes them feel like they should be. He points out that this slide here shows when several of these companies were recently sued by plan sponsors. And none of us are surprised that by plan participants, excuse me. And none of us are surprised that big companies get sued. And none of us are surprised that any of these companies were sued by participants. But Nick likes to point it out because he likes to make the plan sponsor know that these companies aren't going to protect you, because these companies are going to point out that they're not the fiduciary. That's the defense they use whenever they're sued. They're very careful to say we're not the fiduciary. They're very careful not to put themselves as a fiduciary. So while we all know there's going to be some examples of them losing these cases, most of the time they win by saying we're not the fiduciary and you need to talk to the fiduciary. And most of these lawsuits are things that any one of us would have seen coming, like the fees are way out of whack because the plan has grown and nobody's gone back and reviewed the plan. But the point is, Fidelity isn't going to fall on the grenade. They're going to say the plan sponsors should be responsible for this. So Nick will point that out. And then he'll also point out how many settlements big companies have had to make in the last few years. These were all just between 2020 and 2023. Or these were all within 2022 to 2023 lawsuit settlements. And he points out, I realize you may note that these are all big companies, and you have to understand that all of these companies thought they were safe. Once the lawyers run out of the big companies, they're going to come after the smaller companies. Mr. Plan Sponsor, wouldn't you like to have somebody who's going to help protect you? And then Nick just creates that level of doubt by bringing it to the attention all of these issues. Years ago, I found this on the Brightscope website. It was a blog post they had done, and it was a fee analysis they had done of publicly available data. We all know that that's not going to be complete, but it was interesting to me. The orange line represented the average fees, and this is a number of years ago. And the blue diamonds represented all of the plans that had over 100 participants and over $1 million in assets. And when I saw this, just looking at this image, I thought to myself, wouldn't it be great if we knew the names of all the plans that were above that orange line, and we had a solution that was not only above the orange line for fees, but it provided or below the orange line for fees, excuse me. Not only was it below the orange line for fees, but it also added fiduciary protection, 316, 338. It had all the bells and whistles that those other providers offered. I think we would all agree that if we knew the names of those plans above the orange line, we could probably reach out to them. But when I shared this slide with Nick, he said, well, Greg, the plans under the orange line need my help too, because they don't know they're under the orange line. What they don't know is they'd be better served with me as their advisor. To me, that's confidence. And so he decided he doesn't care where they fall. Every plan needs his help because he can do a better job than whoever they're working with. And when he doesn't land a plan, and he doesn't land a lot of plans, there are a lot of plans he meets with that never choose to make the change. But when he doesn't land a plan, he just figures it was their problem and he moves on. Now, I should point out, Nick doesn't make any cold calls. I have done a presentation like this where I've explained Nick before to other advisors, and they all assume he's just a cold call machine, but he's not. He says he hates the idea of cold calls. But that doesn't mean he doesn't call people he doesn't know. He calls lots of people he doesn't know. He just finds a connection to that person. So he happens to be in Farmington, Michigan. So he calls all the businesses in Farmington and says, I'm right down the road from you. I saw some publicly available information. To me, that's a cold call. He doesn't think it's a cold call because I'm connected to that person. We're related. He wouldn't call somebody else that he wasn't connected to. He also, as I said, he asks for referrals. He asks for referrals from lots of people you wouldn't think he would ask for referrals from. If he's out to dinner with a friend, he will ask them for referrals, whether he does any business with that friend at all. He just says, who can I help with their retirement plan? So if you're working with advisors, tell them that you never know where your best lead may come from. His largest plan was on the golf course. It's a $95 million plan now. And when he called me from the golf course and said, actually, he didn't call, he texted. He texted me from the golf course and said, look up this plan. So I went and looked up this company, and somewhere around the ninth hole, I had texted him back everything I found about this company. And he started chatting with the guy about his business. And next thing you know, Nick had a meeting scheduled. He called me up and he said, I'm going to be meeting with them and we need to put together a good story because this is a big plan. And he got this plan because he golfed with them. And he's gotten several plans from strangers he's golfed with, just people he'd been paired up with. So to me, if you're talking to an advisor who says, I don't know where to find plans, or I'm buying leads, there are leads truly everywhere. Most of us understand this, that up to 80% of retirement plan fees come from fund expenses. And most everyone on this call realizes they don't really have to come from fund expenses. The record keepers on this call, most of you are open architecture providers, or many of you are, and you probably would realize that if you were building a plan for yourself, chances are you would use the low cost share classes, and then you would pay flat fees or a small basis point fee for admin and flat fee per head for participants. But a lot of the plans out there don't do it that way, particularly the plans that don't have a real fiduciary looking it over. A lot of the plans will just bury all the fees in the expense ratios. And I think that was even older plans, probably even more so than newer plans. And the reason they do that is it makes it feel like to the plan sponsor that they're not paying anything. Now, most of us would realize that that if you're paying 150 basis points on average for funds, you're paying too much. But the average participant wouldn't understand that, and the average plan sponsor probably wouldn't understand that. Most of us would be aware of the fact that if I have the Growth Fund of America and you have the Growth Fund of America, there could be a great chance that our performance is significantly different because you're in one share class and I'm in another. If I'm in the R1 and you're in the R6, there's a good chance you think you and I look at our fees and we could be off by 100 basis points per year. But we understand that the average participant doesn't, and the average plan sponsor doesn't. I put this slide together to point out that it can be even worse in the group annuity space. It doesn't mean group annuities are bad. Matter of fact, Nick has many plans that are in the group annuity space. But the point is most plan sponsors don't understand the difference. So this is John Hancock, and most of you probably know John Hancock has a range of fee schedules depending on the size of the plan. So if the average advisor were to call John Hancock and they said, I've got $1 million plan and it's got 100 participants and it's a new plan, John Hancock would send them a proposal for that plan. They'd ask, how much do you want to make? And they would send a proposal, and there's a good chance that it would be in the John Hancock USA 9. And if you look over to the far right, you can see the expense ratios. Now, it's because those investments that are listed there are not mutual funds. Those are sub-accounts of the annuity. So while they have the name of the mutual fund and they invest similarly to the mutual fund, the fees are going to be different. And the fees are going to be different because they're hiding a lot of the costs of running the plan in the expense ratio. And it's transparent as that it's part of the fee disclosure, but if you don't have perspective, that fee disclosure doesn't mean a lot to the average plan sponsor. I think you'd agree. Now at the bottom, you can see the actual American funds, Washington Mutual R4, and what the expense ratio for that is. And you can see that it's a significant difference. And again, if you were building your own plan, that might be the fund you'd use, or chances are, if you were building your own plan, you'd probably use the R6 share, which is the lowest expense ratio. And then you would say, I'm going to pay the rest out of pocket. I'm going to pay the admin fees, the per head fees, and I'm going to write those off as a business expense. And so I'm going to use the lowest cost share class. But I suspect most of you would agree, many plan sponsors wouldn't know this. Many advisors wouldn't realize this. I've done this presentation and shown this slide to advisors who sold many plans before, and they didn't realize because they don't think about it, because they're just selling the product they know. Matter of fact, an advisor I work with, he had never sold a 401k before, and it was because he said, I couldn't tell the difference between Principal or John Hancock or Nationwide. So how could I tell them they should move their Nationwide plan to John Hancock? The secret is, if you can understand the plan, you can fix it where it is, or you can recommend an open architecture provider or a lower cost solution, or you can go and negotiate with John Hancock, and John Hancock will help bring the price to a better place. What I believe happens, if we go back to this slide, what I think happens a lot is those plans get into the high expense ratio funds and they're sold, and then 3 or 4 years later, no one has repriced that plan. So those plans that are way up there at 4% a year and they're over $1 million or $2 million, they were probably startup plans, and they were priced perfectly fine for a startup plan, and then they outgrew that plan. So let's move on. So Nick says, I'm going to fix the plan where it is. And the way he fixes the plan where it is, and he believes saying, I'm going to fix the plan where it is, really shortens his sales cycle. Because rather than saying, yeah, we're going to move it, and we're going to move it to July, I saw Cassie on this call, we're going to move it to July, and then there's going to be a blackout period, and we have to teach our HR person all about the web interface. We have to get paperwork and get everything done. And those are all barriers to a move. By saying, I'm going to fix this plan where it is, you've shortened the sales cycle, because all they have to do is say, yes, Nick, I want you. And Nick says, we're going to change the rep of record to me. Then once they've changed the rep of record, and Nick doesn't negotiate fees or anything, he just says, I'll take whatever the current guy's making. Whatever the current advisor's making, I'm going to take. And then once he gets all the information, he may go back and say, you know what, I'm going to reduce my fee because it looks like your current advisor probably hasn't reduced their fee for a while. I'm going to reduce my fee. And then Nick is going to go back in and say, and we're going to bring in a 338, and they're going to take on the liability for those investments. And they're going to review this plan and make sure we get you the best investment lineup. And then we're going to bring in a 316, and the 316 RE service is going to come in and help manage the sign the 5,500 and take on that role. And Nick will bring in all these pieces to the plan sponsor and say, you know what, I realize some of these are going to have some added costs, but we're going to save those costs because we're going to reduce the cost of the investment lineup. And then I'm going to contact John Hancock or Nationwide or Principal or whoever you're with, Fidelity, and I'm going to say, I'd like you to review this, the fees, and they're going to come back with a lower fee. And then he doesn't have to move the plan right away. Now, eventually, he said he would like to consolidate plans because it would be easier. He told me he was on the phone the other day with Fidelity, and some of you may have experience with this, but he said, I have large plans with Fidelity and I have small plans with Fidelity. And my large plans, I have a dedicated person. My small plans, I don't. And he said, and I have to tell you, and I've explained it to Fidelity, I find it very frustrating that I don't have a dedicated person for all the same person for all the plans. And he said he has the same experience with Principal. Now, I'm sure many of you on this call, particularly who are in the record keeper side, would say, well, if Nick worked with me, he would always have a dedicated person. And I'm certain that's true. But some of the bigger players don't always do that. So eventually, I think Nick is going to narrow it down. But shortening the sales cycle is his secret to success. He would not have 400 million under management if he was trying to move every plan. But by keeping it where it is, he's found that it's a great way to successfully capture business, become the rep he is, and then move things. And by the way, I mentioned he's only been in this business maybe 6 years and only 4 years really selling plans. So I suspect his business he just hired an assistant for the first time the end of last year, I think in December. Now you may be asking, what's in it for Q3? Why do I help Nick? Why am I on this call talking about Nick's success? I should probably point out that Q3 offers target date models. We've got our destination target date models are actively managed target dates. They're different than typical target date fund. We review them every Wednesday. We overweight to the strength of the market. They've outperformed their peer group for a number of years. I think for 5 years, most of them are outperforming their peers. And they had been just available until just the end of last year. They were available exclusively for open architecture providers using Mid-Atlantic or Matrix. But at the end of last year, we rolled them out as CITs. So now they can go just about anywhere. So if you're interested in learning more about our models, we've got a white paper, we've got performance reports. I'd be happy to share those with you. In addition to that, Nick and I spoke this morning. I told him I was doing this call, and he has offered to do an interview with me. We did one last year, and we're going to do another one this year where advisors can learn more about how he goes out about his business. So if any of you would like to be invited to the interview, we haven't set a date, but it's going to be sometime in February. If any of you would like to join us, please email me, and I will see to it you get an invitation as soon as we set the date. In addition to that, we put together a program here at Q3 inspired by Nick. We call the 401k Launch, and it's designed to help you fill your pipeline with leads and plans. We'll just essentially be a sounding board for you. I do calls every day with advisors to help them figure out what plan opportunities there are. We'll run lists of plans near you, but more importantly than that, we'll just help you identify companies that may be in your backyard or on the books, maybe that you've got clients who are your retail clients who could introduce you to the business owner. We'll just do our best to make your job easier and walk you through and essentially hold your hand as you close plans. So if any of you are interested in learning more about that, I'm happy to talk to you. We can have a call. If you want to do the launch, please let me know. And with that, I'm open for questions.
Yeah, I think someone just said, when did the 401k originally begin? That was in 1981, I want to say. Was it Ted? I forgot the guy's name who
Ted Benna.
Yeah, Ted Benna. That's right, because the Ted Benna's
Ted Benna.
got a new product.
He was the first.
Yeah,
the first 401k. Right.
I knew it was Ted. I forgot the last name. I'm getting bad with names these days. Next question. In 10 years in business, I used to lead with litigation fear. I never heard a single sponsor react or express the concern back to me. All my plans are $1 million less and 25 or less employees. At what size might fear of litigation really matter?
I think that's a great question, because you're right. A lot of the really small plan sponsors are going to say, they're not going to come after me. I'm not going to be sued. Ari, you and I have talked about the proliferation of lawsuits on the larger plan space. And I think we both know it's going to move downstream because they're going to run out of big plans to sue. But maybe that doesn't get their attention. But what you're really trying to do is demonstrate your expertise. So while they may not think they need Ari today, and they may not think they need you today, if they have an advisor on the plan, don't they want the best advisor on the plan, especially if it doesn't cost them anymore? So while I agree litigation may not be a concern for everyone, you can at least demonstrate that they could have a better plan with you.
Yeah, I mean, I agree. I think that and anyway, to me, the plans that are like not operating efficiently and whatnot, quite honestly, I have more fear of a DOL audit than anything else, because that's the reality of it. DOL, will go through we don't know what they're looking for. And I've been through a lot of DOL audits where it was just painful that somehow you'd rather have litigation. But yeah, I mean, downstream, you're not going to get a lot. I mean, to me, your biggest fear would, if you had an employee who got fired and was terminated and they wanted to get back at you, maybe they'll sue you for the 401k to just get a quick settlement. But outside of that, a class action lawsuit, against a plan with $5 million, the attorney's not going to make any money. So that's why they're not going to pursue it. That's why they're going to go after, the big companies on these forfeiture lawsuits. Better chance, better bounty, a third of suing a $2 billion 401k plan is obviously better than a third of suing a $5 million plan. So,
well, and Ari, you and I are part of a pooled employer plan where you are the named plan fiduciary. And for small plans, it's almost a no-brainer to say to the plan sponsor, I know you've currently got $1 million plan. Why don't you move it into a pooled plan where someone else will take on some of those headaches? Because if there's an audit, wouldn't you rather they call and they get Ari on the phone than you? I say it all the time. Selfishly, I would rather have Ari answering the Department of Labor's phone call.
Yeah, but you know, the problem with selling a PEPs are twofolds. People don't understand it, and two, you still always have these employers who don't want to give up control. So that's like, you know, it's a great solution for most employers, but a lot of people just, you know, don't understand it and don't want to be part of it, which I get. You know, there's not one solution out there in the retirement plan space that is a fit for everyone. I've always said that.
Sure.
Okay, that's I think all the questions we got for that. Again, we're gonna start again tomorrow, 11 a.m. Eastern. I think we start off with our friends with Asset Mark, got presentations for EGPS, Penchecks, MUN CPA, Advance Financial Partners, yours truly, and Pacific Life. We will end around 2:30 tomorrow. Again, keep in mind that this stuff will be on YouTube. Today's will probably be on later. Just go to YouTube, type in that 401k National Conference or that 401k conference, and it should be up there probably later today. So if in case you missed, listen, I don't expect everybody to sit at their desk for 4 hours. You had to go to the restroom, you had a meeting. That's why it's there on YouTube, and it's we're not giving away the secret recipe. It'll be up there for you to watch at your own leisure. Last but not least, Fun One brought to you by Brandywine. Mike, can take it away.
Very good. Hey, thanks, Ari. Okay, I'm Mike Dever with Brandywine Asset Management. We're a fund manager, so we're going to be talking about an innovation that we have that we've been using in our funds, and it's something that's quite unique. So let me bring up my screen here for you.
I see it.
Very good. Okay. So while this presentation is directed to the 401k advisors we have at the conference, I realize we also have some investors in our hedge fund, Safer Equity Fund, on the call. So this investment approach is applicable to that fund as well. Today's presentation intends to do more than simply improve your business. It's intended to transform it. You will be introduced to an entirely new way to not only manage risk in your clients' retirement plans, but in an opposite way of thinking. I will show you how Brandywine's suite of enhanced and target date funds reduce risk in order to increase returns. We see this as setting a new fiduciary standard and the single most beneficial way for you to provide your clients with more money in retirement. At the heart of this transformation is Brandywine's innovation of risk replacement, which, as you will see, changes everything. We'll start by looking at what have been up to now the two primary approaches to investment management: active and passive investing. We'll start with active investing. The traditional approach to active management is to identify and allocate to stocks or sectors that are likely to outperform. This often leads to increased risk in addition to the desire to increase returns. But despite its intent to provide market-beating returns, active investing has failed. Fewer than 20% of all actively managed equity funds have outperformed their benchmarks over the last 10 years. In fact, only 13% of the actively managed U.S. domestic equity funds have. And for those of you who have been approached by wholesalers pitching you why their currently outperforming fund is different, there's more sobering information. Of the 529 top quartile funds in 2019, none of them remain in the top quartile over the next 4 years. Clearly, there is something wrong with every fund management company's approach to active investing. As a result, many investment advisors have given up on trying to pick the next hot active fund and have instead chosen to essentially do nothing. They are focused on selecting only passive funds for their client plans. While there is a good side to this approach, most notably in that each fund closely tracks its benchmark index, and as a result, outperforms the universe of active funds, there are serious downsides. Again, because each fund closely tracks its benchmark index. This means that passive investing exposes your clients to multiple dramatic and recurring bear markets, which can get quite ugly. because passive investing does nothing to protect the downside. Well, let me rephrase that. Your clients will lose a lot of money. Your clients are exposed to naked downside risk. Because of this, you must first prepare your clients for bear markets. Then second, handhold them through each drawdown. But even when you are successful with that, the result is that you are forced to watch, intentionally helpless, as their potential retirement income gets slashed by 20, 30, 40% or more in a bear market. And if that's not enough already, the difficulty of holding hands increases not just with the magnitude of the bear market, but the duration. People will suffer through losses if recoveries come quickly. But as you know, they are far more likely to pull the plug or the account from you if the losses extend for more than a year or two. So passive investing forces you to play defense and psychiatrist. It's not constructive. And sitting helpless through extended bear markets does nothing to help you differentiate your practice. But there is now a better way. Instead of doing nothing, you can do the opposite. Before I explain, let me share with you the advice of the leading financial analyst of the past 30 years, Jerry Seinfeld. These next 3 slides are from the Seinfeld episode, The Opposite, that aired in 1994. It starts with Jerry's friend, George Costanza, lamenting about how his life has gone all wrong.
Yeah, I don't hear it.
Can't hear it? Let me stop a second. Hold on. There's all hidden controls. Sorry about that. All right.
Every decision I've ever made in my entire life has been wrong. My life is the complete opposite of everything I want it to be. Every instinct I have in every aspect of life, be it something to wear, something to eat, it's all been wrong.
So then Jerry Seinfeld makes a very astute, simple observation.
If every instinct you have is wrong, then the opposite would have to be right.
So now George tests Jerry's theory by approaching a woman at the counter who's been looking over at their table.
Excuse me, I couldn't help but notice that you were looking in my direction.
Oh, yes, I was. You just ordered the same exact lunch as me.
My name is George. I'm unemployed and I live with my parents.
I'm Victoria. Hi.
So I think it's one of the best skits in comedy, and it works. George gets the girl by doing the opposite of what his instincts tell him to do. Now I'm going to show you how that applies to fund management. Instead of seeking out the hot stocks in order to outperform, which potentially increases portfolio risk, you should, and now because of Brandywine, can reduce risk in order to increase returns. Warren Buffett had it right when he said the first rule of investing is don't lose money. The second rule is don't forget the first rule. Investors suffer bear market losses on average once every 4 years. With a loss of 35%, it takes recovery profits of 54% just to get back to even. If instead those declines are reduced to just 20%, recoveries can start from higher levels, and that same 54% return produces 23% in new high profits. This leads to another quote, this one from Benjamin Franklin. Money makes money, and the money that money makes money. Meaning the less you lose, the more money you have with which to make even more money. Brandywine follows this philosophy, and our investment approach, defined by our innovation of risk replacement, signifies the next progression in portfolio management. Risk replacement, which addresses the flaws inherent in active and passive investing, is employed across our suite of 14 core enhanced and target date funds. It takes the opposite approach from active investing by reducing loss in order to increase returns. And it provides a dramatic improvement over passive investing in that it is not only structured to reduce bear market losses and mitigate sequence of return risk, but because of that loss reduction, it holds the potential to increase returns. So the combination of downside protection, unconstrained upside potential, and increased portfolio diversification transforms fund management. Here's how and why it works. We start by purchasing 100% exposure to each fund's benchmark index. In the case of our Brandywine Large Cap Fund, this is the Russell 1000. We then purchase put options to protect a portion of the benchmark exposure and maintain that protection at all times. This provides three significant benefits. First, when bear markets occur, even out of the blue, because the protection's on all the time, it preserves significant amounts of your client's capital and allows recoveries to start from higher levels. This increases the ability to compound returns. Second, it helps mitigate sequence of return risk. And third, it makes it even easier, to handhold your clients through those prolonged bear market periods. The third constituent of risk replacement, perhaps the secret sauce, is the addition of Brandywine's return driver diversifier. This is a non-correlated and broadly diversified overlay that is structured to pay for the cost of the put option protection over time. It's based on our 40 years of experience in trading across a broad range of strategies and markets. And because Brandywine's return driver diversifier is only intended to earn a couple % per year, enough to pay for the cost of the put protection, and it is more broadly diversified across return drivers and markets than each fund's underlying benchmark index, it is subject to far lower risk than the benchmark index. And it's almost totally avoid of having singular event risk, such as a DeepSeek, announcement. In fact, the probability of a bear market in the return driver diversifier is just 1/4 that of the risk of a bear market occurring in the Russell 1000. So that's risk replacement. 100% equity exposure is maintained, but a portion of the risk of owning the Russell 1000 is offset by the put option protection and then replaced by the lower risk of holding a smaller allocation made to Brandywine's return driver diversifier. The potential benefit is clear when we add the tested performance of our Brandywine Large Cap Fund to the chart we saw previously, showing the performance of passive investing during the 2000s. While this performance is hypothetical, as we hadn't yet discovered risk replacement in 2000, it does show how during each of the bear markets during the 2000s, Brandywine Large Cap Fund would have dropped a fraction of the amount lost by the Russell 1000. It's not magic, just math, as the put options pay into the fund as the market falls in price. This provided a huge head start when the market recovered. It's like competing in the 100-meter dash while starting on the 30-meter line. The dramatic difference shows how risk replacement has the potential to turn a bear market decade, averaging 1%, almost 1% annual declines, into a strong bull market performance of almost 7% annualized returns. And because the return driver diversifier is structured to pay for the cost of the put protection over time, the funds may even outperform during a bull market period. You can see that here, which combines Brandywine's verified and actual performance during the bull market here of the 2010s and 20s. Losses are significantly reduced from 24% to 17%, which in line with the philosophy of reduced loss equals increased returns, leads to an almost 2% outperformance in annualized returns. And this performance continues to today with Brandywine's suite of enhanced and target date funds. It's a CIT suite. You can see looking at the actual performance of Brandywine's suite of funds shows performance that is in line with all expectations from prior back tests and the verified performance that started in January 2013. On average, maximum loss has been reduced by more than 30%, volatility by more than 20%, and at the same time, despite while investing in a raging bull market, Brandywine's suite of CIT funds has outperformed, on average, almost 1% against both their benchmarks and peer groups. Risk replacement is not theoretical, it works. Risk replacement is especially transformational for target date funds. This slide compares Brandywine Target 2040 to the comparable fund for each of the 5 largest target date families. Now let me explain this slide. First, what the graph in the upper left shows is clearly is that the top 5 fund families are all essentially the same. Despite having 2 through, active or passive, their performances are all bunched together. They deviate very little from each other. Only Brandywine stands out. Second, the capture ratio chart on the bottom right shows upside capture at the top of the bar and the downside capture at the bottom. Two of those are actually reversed, where their upside capture is less than their downside capture. What's extremely clear is that Brandywine's capture ratio engulfs that of the other funds. Brandywine captures both more of the upside, and because we offer the only target date funds with downside protection, far less of the downside than the other funds. One additional, almost startling point that's not shown on this slide is that the retirement income funds for two of the fund families, which are their most conservative target date funds, had greater losses in the 2022 bear market than Brandywine's longest dated and most aggressive Brandywine Target 2060 fund. Think about that. The most conservative funds from each of those two families actually suffered greater losses than Brandywine's most aggressive target date fund. That's the difference between all other target date funds that hope to protect against loss by diversifying into bonds, and Brandywine's target date funds, which directly protect against loss using Brandywine's innovation of risk replacement. Brandywine's suite of 9 core enhanced and 5 target date funds each maintain a high R-squared correlation to their benchmarks and are therefore designed to serve as a replacement for the naked risk funds you currently hold in your clients' portfolios. While it was natural for us to leverage our 40 years of experience in managing absolute return strategies and develop these funds, what we've been hearing from retirement industry experts is that these are a game changer for the retirement industry. And others have told us it would be prudent for them not to consider these funds for their client plans. It is feedback such as this that leads us to believe the playing field has changed and that risk replacement has set a new fiduciary standard. And right here we have our footnotes and disclaimers that'll be appearing on the YouTube slides. So I'm open to your thoughts and questions. Thank you.
Thanks, Mike. Where are these funds available? I mean, how they reach out to you?
Yeah, so Fund One is handling, talking to people and bringing them in to introduce to these funds. They can reach us directly at mike@brandywine.com. Is my email address. These are CITs. They're on all the major record keeper platforms. Our trustees is Alta Trust on the funds.
Okay, so they'd be available on Matrix or, some of the other.
Principal, Matrix, Fidelity, Empower, all the major record keepers.
Okay, perfect. So they'll be able to, if anybody's interested, reach out to Mike or reach out to me, and I'll make sure Mike gets your emails. So thank you so much. So we end a little bit early. And again, we will be on tomorrow at 11 a.m. Eastern with a whole new set of presentations. I think I'll be on at 1:30. So I think we're actually going to end at 2:30 tomorrow. And like I said, whatever you missed, it should be up on YouTube later today. And of course, I always have to plug those live conferences. I think Mike's going to be there in Kansas City. Go to that 401ksite.com for further information on the KC event and the Anaheim event. And eventually, within a month or so, we'll have something on Milwaukee. So until then, until tomorrow, thank you for being part. Take care. Bye.
Thanks, Ari.